Firstly, obviously, just welcome to everyone for coming along today. And if this is your first introduction to Wholesale Investor, just want to give you a quick bit of background about our company. We actually launched our business in the month of October 2008. So if anyone can remember that period, we were launching the first week of October, whilst the Dow Jones was crashing 19%, we were actually launching our business. And I remember we were at our launch party, and there was a lady that come up to me and she goes, she basically said, I can't believe these guys are launching their business right now. They're absolutely mad. Not knowing that I was the founder, right? And I think that pretty much summarizes this entire space, especially if you look at the environment right now. And we initially as a company, we started off as a magazine, and that lasted till about 2012. And then we made the move to being sort of an online to offline sort of platform. And that sort of happened right up until about 2019. Then of course, 2020 came, and we had to double down on what we do from a platform perspective. And so now what you see today is the culmination of that period where everything about WI is about creating opportunities for tomorrow. That is what I love about what we do. Every single conversation you guys will have today, every company that's featured, every email we send, every event we host, every webinar we host, everything is about creating something which doesn't exist. Our mission is about empowering ambition, capital, and basically bringing that together in this type of format. And that's some of the parts that's really important for me. Now, the other part is we want to break down the global barriers to deal making. So a lot of what we do is actually across Australia, Singapore, and then now obviously you're seeing from a UK perspective. So my talk at the start, and I'll give a bit of an introduction. The whole reason we're doing the Capital Expo is normally what we do is focused around purely the investment side. That's what people know us for. For the Capital Expo, we want it to be not just around investment, but also strategic opportunities and also commercial opportunities. So as you're going around chatting to the different companies that are actually featured today, those are the three elements that I want you to have in mind: investment, strategic, and also commercial opportunities. The other thing I know about this space that's very prevalent is that every single one of us have in our networks between 10 to 15 people that are also active in this space as well. How we've actually grown as a company is by word of mouth, right? And so after this event, what we want to do our best to do is to invite more and more, because typically we will host anywhere between 3 to 6 offline activities, as well as we do a bunch of online activities as well throughout the year. And so just keep those things in mind as we're going through it. Now, as much as we've done everything to create the experience for this event offline, there's actually an incredible experience for you online as well. So as a next step, can I just get everyone to get out their phones? How rare is that? Someone hosting an event asking you to bring out your phone, not put them down. So go to that address, app.crisp.io, because what we've done is we've created a seamless experience for you for this event where everything is integrated and you can actually network with each other, and you can actually network with all the attendees inside the actual platform. So go to app.crisp.io. The easiest way to sign in is in with your Google account or with your LinkedIn account. Then once you've done that, the next step is just to put in some basic investment preferences, just really simple stuff like stage, sector, etc. Just go through that process, and it's okay if you keep on doing it whilst I'm talking. I've got no problems with that. And then after you've done that, after you've gone through those investment preferences, then what it does is you'll see, as you've gone into the platform and you've logged in, you'll see a nice red button, and then you see the London Capital Expo. When you actually see that London Capital Expo, if you click on that button, that's when you actually get the conference experience that we want for you online. Now, there's a couple different elements to that conference experience. You'll notice that it's got all the exhibitors featured with direct access to their information and their deal rooms, right? So whilst you're listening to the presentations today, you can actually filter the type. If you like fintech companies, for example, you can actually just put fintech in there and you can see all the fintech companies that are featured here today as well, and then go about your list. You can favorite certain companies because you may really like a presentation. You think, I'll favorite that and I'll come visit it later, right? The other part that most people love is we've got a networking zone. And inside that networking zone, you can actually communicate with obviously all the companies featured, but also you can communicate with each other. Said everything we are about is about building ecosystems, and we really want to facilitate that as part of this actual conference, right? So in there, and then what you're going to find after the event, we're going to upload this content to that actual, to the app, and you'll be able to watch these presentations again if you want, or if you missed a presentation, you can come back to it, etc. Or obviously you can see the companies that have been featured as well. So we've tried to make this as simplified as possible for you with this actual process. So app.chris.o, set the investment preferences, and then when you say, and the reason we actually built our own conference software is because I got annoyed trying to use other people's software. And I want it to be completely integrated into the experience. And when you actually go in there, who's actually in there already out of curiosity, right? How much nicer is the actual experience from seeing who else is coming along? There's lots of different filters you can use as far as types of people you want to meet and all that sort of stuff. And it's easy from a search functionality perspective as well. Okay, so that should be very simplified for you. Okay, now obviously we've got an incredible lineup of speakers today across a couple different areas, right? Obviously to be able to listen to, the team when talking from a climate tech perspective, for us, we've been very fortunate across Australia, Singapore and the UK to work with some incredible companies in sustainability, renewable energy tech, and so forth. And that's been one of our core strengths over this last sort of 12 months. So obviously got a panel session in that area, and then obviously just the general VC investment trends. When there's as much turmoil that's going on right now, I always love hearing from the people, the ones that are actually having to make the bets into companies which they're looking to invest into, because I want to understand their helicopter perspective as to how they're actually seeing things. And then also got an incredible keynote from Nathan coming up just straight after me as well. And then obviously to finish, we've also got an incredible keynote with Jenny from the UK Business Angels Association. And so as I said, we've done our best to stack the day from a presentation perspective. Once again, don't forget we've got 57 companies outside that you've got the opportunity to network with, understand, learn about their business throughout the day as well. So it starts out obviously with Nathan as the keynote, then the climate tech panel session, then the investment trends, and then obviously finishing with Jenny's keynote. And then after that, typically everyone's favorite part, the WI private, where we've got our networking drinks. So that's typically, the funniest part is, as hard as you work for an event, it seems to be so easy to get people to come along to the networking drinks for some reason. All right, so my presentation is going to be around what our observations are, and this is going to be super high level, but the innovation and technology trends, right? It's that culmination of what we're actually seeing. And for me, when I've looked at this last period, this is pretty much everything we've been all bombarded with pretty much 2022. This is the summary of what we've seen from you guys may as well add politics to that as well, just for some additional fun. But this has obviously been a challenging year for everyone in every different way. But do you know what's crazy about this environment? Is coming to a day like today is like a bubble of optimism. It's a really funny thing. You're going to go around, you're going to listen to the presentations, you're going to meet with all different sorts of people, and then you're going to walk outside and then have a different experience when you actually go online and look at the content. And that's what I love about this space. The most optimistic people on the planet are in the innovation space, and that's what I love about it. And of course, the other part we know is that times like this actually accelerate trends, right? The GFC accelerated technological trends. Then COVID accelerated technological trends. Now, some of that's come back since, but it hasn't stopped it. There's one thing about innovation is once it's out of the bottle, it keeps on driving forward. But it's important to know that. And so when I was actually sort of forming my own investments thesis and how I think about this, because that helps me understand the direction I want to take my business. You think about what are the different reasons that startups succeed. By the way, has anyone watched this actual video from Bill Gross? It's actually one of the best YouTube videos you can watch. It only goes for 5 minutes. It's from Bill Gross. It's called The Single Biggest Reason Why Startups Succeed. It's incredibly empowering when you're actually watching it, when you sit down and think about it. What he did was he made 200 investments, and this was back in 2016, I think, this video. He made 200 investments, and he wanted to understand what is the difference between the ones that succeeded, the ones that sort of went okay, and the ones that failed. What was the big difference? And so these were the 5 criteria that his analyst team worked across as far as what is the difference with these, whether it be the idea, the team, the business model, the funding, the timing, etc. And it was really interesting when they analysed those 200 companies. And the one that they gave the example, right, was a company that was actually an early competitor to YouTube. So when he broke it down, it's unfortunate my animations aren't working. I would have built up to the main one, but that didn't happen. So what he worked out was effectively the number one reason why startups succeed and fail is the timing aspect. And this is why it's so important when we talk about climate tech right now. But effectively, the example he used was a competitor to YouTube. Now, this company was actually launched before YouTube, right? It was about 2 years beforehand. Now, if anyone's old enough to remember what it was like trying to watch a video online, remember when you had to actually import codec, you had to get some type of player, then you had to import it. It wasn't as simple as just going onto a browser and then watching a video, right? And and he had a company that was in that area. Now, what was interesting was YouTube come along 2 years later, raised a lot less money than what they did, but his company he was in failed. And that really sort of identified for him the power of timing. And this also relates to everything that we look at from our perspective. The two main driving forces that I sort of look at when I'm thinking about how do I drive my business going forward is these two, the generational and then also the technological trends. Because now we're entering a cycle where it's going to be for the next 10 to 20 years, these factors that are going to make the biggest difference. Because the last cycle is actually really driven by the baby boomers, right? And if you think about this cycle, where's it actually being driven by? And effectively, it's the millennials and Gen Z. And if you think about the fundamental reason behind that, there's obviously a different characteristic, there's a different personality. But really, millennials now are coming into their peak earning capacity. Now, what else are they doing when they're coming into their peak earning capacity? They're also coming to their peak spending capacity as well. So if you think about some of these trends and where they're actually deciding to invest and spend their money, their character is different, their personality is different, their worldview is very different. And so that makes it really interesting from us as people, whether it be from a platform perspective, looking to what we showcase opportunities to investors, but also from investors' perspective, trying to make bets on the future. This millennial wealth transfer has been going on for the last few years. It is one of the biggest financial shifts that are actually taking place right now, where the money from baby boomers is actually being transferred to millennials. In the US, they calculate it as $24 trillion of wealth being transferred, right? And then and I use the one from Australia as well, right? But in the UK, it'd be the exact same thing. There's a massive wealth transfer going on. So not only are millennials coming to their peak and Gen Z coming to their peak spending power, and peak earning capacity, they're also going to be inheriting a lot of money from their parents. And so that's where these dynamics of this market really start to change. And simple things like access, not ownership, is really interesting. Whether it be all different types of things, whether it be from things like as far as Airbnb, whether it be cars, whether it be whatever industry you're going into, this opportunity of getting access to things and not ownership really transforms things. Netflix is a specific example. Like when was the last time someone actually bought a DVD so they could actually own it? Right? And then the subscription models that come off the back of it, the business models that come off the back of that, the sharing economy, the gig economy, etc. All these things start to transform when you actually have a look at this. I love this comment of 25 years from now, car sharing will be the norm and car ownership an anomaly. We had a client in Australia that ended up being acquired by Uber that did exactly that, right? Now, the next part is obviously the trend in wellness. I think pretty much all of us wear some type of health device on ourselves, whether it be an Apple Watch that's connected where we're tracking our sleep, tracking our health in some sort of way. Every one of us. The food trends that go alongside of that, how we actually take care of ourselves, it's a massive industry going forward. And then the personalization of healthcare as well, whether it be from a pharmaceutical, whether it just be from a general personal healthcare perspective. ESG is obviously been massive. In the UK, it's been strong for a lot of years. And then obviously we're talking about electric vehicles. Now, what's really interesting when you think about, and I'll go through a slide in a second about how fast this becomes the norm, even these forecasted sales to me is actually well out, right? But I put that up as an example, and I'll give you the example why, right? But this to me is one of the most powerful trends. If you think about the transformation from ICE vehicles to electric vehicles, how many industries that change? What does the future petrol station look like? For an example, what do future residential apartments look like? As an example, right? A lot of things change when revolutions take place or enablement of different technologies take place in this area. Buy now, pay later has obviously been a massive one. Now, although they've been smashed in the last sort of 12 to 18 months, right? Who would have thought, especially in my generation, who would have thought that a credit card just wasn't enough? It's crazy to me. I don't know if it's the same as the UK, but in Australia, you can actually go to a pub and buy a drink on buy now, pay later. That is nuts, right? Just think about like to buy, say, the $10. So anyway, for me, I found this interesting. That was never a problem. And it's one of those things. People always talk in this space about problems, investing and trying to find people that are solving big problems. I never thought getting a credit card was a big problem. But turns out there was a whole generation of people that did. And that's where the transformation takes place. And the lesson I'll have is from one of my mentors. And it was really interesting for me. So in Australia, obviously there's a lot of, there's a lot of services, home services style businesses that are very much platform driven. So one of my mentors actually invested an 8-figure sum into one of these businesses. Now basically what he did was he went around and he met with all of them because he thought, this is an area I want to make a bet in and I want to understand what all the different players are doing and how they're thinking about their growth strategy. And so there was 2 companies which he identified to me, and this is really what started to shape the way I think about my own business. One business he met with, right, it had somewhere like 12 to 15 salespeople, and it had something like 3 to 4 engineers, right, at that time. It was in the earlier days. The other business he met had almost the reverse. They had something like 10 to 12 engineers, and they only had 2 people in sales and marketing. Which business do you think he invested into? First or the second? Feel free to shout out, no need to be shy. First, second? The second. Do you know why? Scalability, right? Because from a software perspective, it is infinitely scalable. From a human perspective, there's a limit on what humans can actually do. And what's interesting is in that home services business, because it was driven by engineers and because it was driven by software, there's an unlimited amount of verticals which they can create inside their actual marketplace, right? And now today, that is far more dominant than the one that he could have actually invested into. And that really starts to get you thinking about the business models which you actually look at and the potential in which they can actually create. Now, I love this law. I learned this from ARK Invest, which I'm sure many of you guys follow Kathy's work. I found that really interesting because I think it also relates to software production as well in the way in which companies can produce revenue. And basically what he discovered was that when he was studying aeroplane manufacturing, he determined that every doubling of aeroplane manufacturing actually reduced the actual cost, the labor requirement and the cost associated with it. Now, what's interesting about this is we're seeing this across a lot of different areas. Solar is one of them. If you think about the price of solar 20 years ago, it's very different to what the price is now. And I'll show you an example in a second. Right? But this also becomes interesting from a software perspective because the infinite amount of what it can create from a production perspective is what becomes interesting. And then, of course, we always talk about CAC in this word. The cost of customer acquisition comes dramatically down over time because of what it can actually produce. The other part that's really interesting is adoption curves. So I showed you the electric vehicle stats before. How long, does anyone know the stats of how long was the transition from horse and cart to the first cars before it went from 0 penetration to 80%? It was about, I think it was 16 years or something ridiculous like that. So what's really interesting about this, now here's another question for you. Who remembers BlackBerry phone? Right? How long was the adoption from BlackBerry to iPhone? That is the power of adoption curves. It absolutely decimates the existing industry. Same with Nokia phones as an example, right? It absolutely decimates. So there's something powerful about this. Now, electric vehicles have just crossed 5% as far as global ownership. Now, what's really interesting is when people see in the next 10 years, that is going to go crossing from the innovators right up to the early to late majority of adoption in the space of a very, very short time. Adoptions do not happen linear, so they happen in this curve effect, and it's just been proven time and time again, right? Because there's a bunch of factors taking place at the one time. Now, just remember Wright's law for a moment. So we've got Wright's law, the S adoption curve effect, right? Then we've also got all these different factors taking place right now as well in our worlds, right? Obviously, when Tesla announced their layoffs, obviously we've seen a lot more, right? This white-collar redundancy is going to be interesting over the next 2 to 5 years. Just think about how many companies are working on solving basically automation and AI software to actually make white-collar jobs redundant. People talk about the manufacturing industry. What happens when that takes place in white-collar roles, right? So first one, everyone knows software was eating the world, and now AI is eating software. Most of the companies that you will see today have got AI incorporated into their business in some way. I know we do from a platform perspective, right? Because we need to as far as our innovation. This one, AI is quietly eating up the world's workforce with job automation. The potential over the next 5 years for every company to have their team members get more productivity from software and from AI dramatically changes what companies are able to do and how they're able to produce, right? The other one I find interesting is the vertical SaaS, right? People know companies like Salesforce, where it's a very horizontal SaaS going across lots of different areas. The vertical SaaS just picks one industry and absolutely nails that industry as far as making sure it's a vertical segment that they sort of own and operate. That's interesting to me because that's relevant to me. And then this one, everyone knows for B2C businesses have incredible opportunity to build their business off platforms like Facebook, like TikTok, like Instagram, etc., all the different social networking platforms. Well, guess what? Now B2B marketers also have that potential as well. Why? Because of the globalization of data. It's incredible if you're a B2B company, your ability to get access to data and then to do marketing, personalized marketing at scale is phenomenal in how it's actually transformed. That also changes the way people can be thinking about it. Now, one of the things I mentioned about renewable energy, solar is now the cheapest energy on the planet, right? That was not the case 20 years ago. So when you think it makes a difference from adoption curves, when that pricing goes below what the incumbent is, that's when it starts to change from a demand perspective, right? It said wind and solar is now cheaper than fossil fuel generated electricity. Next one, the sequencing of genomes, and this is where it comes to personalized healthcare solutions, right? Think about how it was $1 billion. Now it's come all the way, it's come down to, that should be 2022. 2022 is down to $338. That is Wright's law at true effect. Said where the more it gets manufactured, the cheaper it becomes to actually produce. And this will also become the same for companies in the outcomes which they can produce for their clients as well. Next one. Okay, the move from efficiency, said, and on demand. Said none of us had bad, for those who remember Blockbuster, we actually had great experiences going to Blockbuster to pick a video. It was a family experience. So good that Netflix have got a whole thing around it. But anyway, it's funny that Netflix are doing a TV show on Blockbuster. I find that entertaining. But if you think about it, Netflix absolutely decimated with an on-demand opportunity. Uber, same thing with taxi. I remember the first time I came to the UK, how hard it was to actually get a taxi in certain locations. There was nothing like being able to see a little black dot on its way to come pick me up and how long it was going to come, right? That became my on-demand experience that I expected. Markets ultimately will move towards solutions which save time, save money, and improve efficiency. And once again, AI and deep learning will become core in across every single industry that where most of us are operating in. Whether it be traditional services like accounting, legal, whether it be in our area, said as a platform, it's expected that we utilize something like AI, right, and ML to actually do matchmaking for you. It's funny, not many do it, but that's why we invested into it from our side, right? It's like, how do I deconstruct, if you ever met me, I'm a natural matchmaker. How do you deconstruct how you do matchmaking and then make that scalable? And the only way you can do that is via software and via AI ML, right? More and more, and it's becoming cheaper for companies to do that. What we're doing now from a platform perspective would have cost millions previously, right? It doesn't cost that much anymore. And that once again goes to that adoption curve aspect and also the Wright's law component. Genomics, I mentioned that before. What's really cool about this is you look at all the different areas. When you have technological platforms like this, it benefits all sorts of other areas and it benefits all the people operating in those areas as well. And that's why it's not just money to be made in the area of genomics, but all the areas around the fringe of genomics as well, whether it be in agriculture, whether it be in therapeutics, diagnostics, gene editing, etc. There's all these other beneficial areas. Renewable energy infrastructure. If you think about it by 2030, 2035, if there is that S-curve adoption of electric vehicles, just think about how that changes so many different areas, and I highlighted them beforehand. There is so much money to be made on those fringe areas, it changes a lot. 3D printing as another area. Once again, another technological platform where there's a lot more opportunities which will be created. Effectively, where this is going is the output just becomes increasingly more and more productive per individual human being, but also we become more and more reliant on technology. And then I use the example of crypto. Whilst crypto is getting smashed at the moment, you may as well throw this in. Something like Ethereum, the adoption of it, right, said it takes place effectively, even with crypto, the adoption is pretty much where the internet was at in sort of 1998, 1999, right? It's going to go through its cycles. I can't remember what the website was about how many times Bitcoin is dead, right? But effectively, the adoption curve is still going incredibly strong. Once innovation is out of the bottle, it doesn't stop. And my last favorite one that I love, because our business is built off this, is Metcalfe's Law, the ecosystem effect. Do you know what's so nice about today? Just look around at everyone in the room and then think to yourself, one conversation becomes, if you meet one person here today, they could introduce you to 2 more people. And then if you think about that network effect that gets created 5 years down the track, it's unbelievable. And this is what I love about the power of events, right? Because it can open up so many doors that you never expected. So Sven, he mentioned he came to one of our events 3 years ago, right? Typically, you can't often normally remember that. But I said, this is what's important. And it's funny, all the connections get made today. I love seeing the way in which it unfolds. But I said, you have 1 mobile phone, it's useless. You have 2 mobile phones, a little bit more, you can actually call someone. You have 1 million mobile phones, that's network effect. And that's, I suppose, what a lot of us are trying to create in our businesses is that, because it's highly valuable. The other thing, obviously, from fintech applications, we can all see these different trends that are coming down the line. Innovation is bumpy, massively bumpy. And funny enough, even if you look at the first exchanges, back in the early 1700s, the first marketplace, they had all the exact same issues that are taking place right now. But it wouldn't have been as known because you didn't have the massive network effects and social platforms that you have. But I find it interesting about how the community value creation is also becoming part of the way. Part of how I think about what I do is how can I actually help the community create additional value inside our ecosystem, right? Because that's now becoming very normal in what people do. And the last one is the rising tide lifts all boats. So when you're thinking about the different sectors and different areas that you look at, effectively there's all the areas around it that are also going to be lifted up at the exact same time as well. Right? And the perfect examples of that, whether it be Uber, Airbnb, Bitcoin, just think about some of the revolutions that they've started and how they've actually changed the way in which people operate, how they have holidays, how they transact, how they create businesses, the technologies that have come off the back of it, etc. It is absolutely incredible. Okay, and then obviously the business models as well that have come from it, whether it be the marketplaces, the platforms, or the subscription-based businesses. A lot of things get changed in this transformation process. So that's it from me. I hope you enjoyed the presentation. Once again, I thank you everyone for coming along. As mentioned, the best way to get the experience, the best way to get the most value out of today is to engage, right? Engage online via the software that I showed you before, via the Chris software. Try and filter who you want to connect with and try and meet with them today. The other part is make sure you go around and chat with companies that are actually featured today. I said, what I love about this space is the founders are working 24/7 to build their businesses. They've all come here today to meet with you. They want to connect with you. They want to engage with you on the premise of having a chat around whether it be strategic opportunities, commercial opportunities, or investment, right? That is what makes this whole thing unique. Thank you everyone for coming along today. Welcome to the WI Capital Expo. And over to our next speaker, Nathan.
Hi everyone, how's it going? Thanks Steve for that intro. So my name's Nathan Keller. I'm the founder and partner at True Attitude. A bit about True Attitude if you're not aware of the company. We start out London-based firm. We're in investment and advisory. The business was started approximately 4 years ago by my business partner, Darko, and myself, off the back of a tech exit from an Australian business called Tamando. At the time, we were sort of positioning ourselves through looking at what we wanted to do, and we really wanted to get back into helping startups. As a business, we do capital planning strategy, we do fundraising, and we help with growth advisory. Our businesses offices around the world, Sydney, Dubai, where our head office is in Abu Dhabi as well, and London as well. Now, understanding, with the room, my understanding today is around 50% in investment, around 30% in founders. What I loved about today and why I said yes to doing the keynote is because I understand that market. I've been both of those. I've also been in the corporate environment as well, which apparently accounts for the extra 20% in the room. I've learned a lot of lessons there, learned a lot of mistakes. This path is, the way we go through it, but where I've ended up, obviously, the family office. We've got around 42 investments into businesses at the moment in our portfolio, and we're sort of assisting them on a day-to-day basis. So that was a lot less embarrassing on the laptop, but that skinny arm man there was in 2011. Very rarely do you get a photo when your life changed, but this is when it happened. That day, I was a corporate guy, was climbing a ladder. All I cared about was, getting to the top of a big multinational company. Didn't really know what the word entrepreneur meant. Certainly had never thought of investing into businesses. And I met the gentleman in the middle there, Carl Hartman, who's still a mate to this day. He inspired me with his enthusiasm, his excitement. I'd never met someone like him at that stage. And what he did was basically talk me into investing into his business that day. I went home, said, we're going to drop some money into this business. A year later, I was in that business, and we exited that business in 2017. Since that day, all I've wanted to do is help startups and help founders in getting their dreams off the ground. Some of my team sitting here, but on a day-to-day basis, we're working with founders. I'm inspired, by the challenges. I'm also inspired by people who are willing to put money into those businesses at a risk. We've evolved over a period of time, but certainly as one of the things that came true was not everyone has that moment captured in a photo like I do. I can say that's when it changed. It was just by chance. But you don't always know that. And certainly when you start a business, you don't know it. There's moments that happen in the course of doing a startup that you think might be huge, they don't end up being huge. There's some bits that you only notice when you come back to it. And as when I talk to most startups, everyone listens to podcasts, and it's great that there is podcasts providing information to people now. But when you listen to a founder who's exited a unicorn business, it sounds very sequential. You do this, you do this, you do this, you get $1 billion. That's not how it works. And to be honest, most of those people, until they look back at it, won't know that those events were important in their lives. But sometimes they won't even know what was important or how they got there. So as an investor, often we think about the things that, founders have exited a business before, and you think, okay, well, if they've done it once, they can do it again. Not a guarantee once again. So, the investment side of things comes down to a lot of factors, and I'll go through those today. Now, when we were coming up with the name True Attitude, a marketing agency presented it to us, and we said, well, what does it mean? And basically, they gave an example from a movie, if you've seen it, First Man with Ryan Gosling, the Neil Armstrong story. So there's a moment right at the start of that where he's jetting along at the top of the atmosphere, and he's got to hit the afterburners, and he doesn't know when to hit it, right? He's had a lot of experience, but he doesn't know when to hit it. If he hits it too quick, shoots off into space, he's gone forever. If he doesn't hit it quick enough, he's going to plummet to Earth and die. So he hits the afterburners, and it was perfect. And that just came from experience and taking a chance and being prepared when he did that. We love that, and therefore that's where our name of our business came from. But a big part of what we do as a business is to try and help founders in making sure that they're ready for that moment. Because you don't know when that moment's coming, but you've got to trust the process. You've got to be ready for it. I put there about ShipShape. I don't know if Daniel's in the room. No? Daniel Salter. There's a company, ShipShape, and we met with him a couple of weeks ago, and he was talking about how ready founders are when they're presenting. So he mentioned that only 75%, sorry, I'll get these numbers. So he said only 75% of founders when they're going for a fundraise have a financial model ready. Only 60% have a business plan ready. And believe it or not, only 35% have a DD room. So in terms of preparation, sometimes we're sorely lacking. And mostly it's just because people haven't done it before. That's the one thing we do notice with people who have been there before and have exited businesses. They're normally better at that side of it. Doesn't guarantee success, but they're better prepared. So just looking at the last month, what's happened in the market, and I thought it'd be good to sort of cover off on a few of those. Firstly, the big 6 tech stocks, $500 billion have gone off the value of those businesses. Now, to put that into focus, there's only 23 countries with a GDP higher than that figure, and we'd lost that in the space of a couple of weeks off these tech stocks. Made.com. If everyone's familiar with that, obviously in Europe, it's a substantial business. Obviously had a great period during the pandemic. Everyone was locked in their house. All they could spend money on was making their house look better. Made.com, however, a couple of months ago, valued at about $770 million. Last week sold for $3.4 million. Now, what happened there? Well, if you read into it and the tea leaves, supply chain issues, they had issues with spending dropping. There was a number of factors there, but not one of those factors wouldn't have come up in a due diligence when it was valued at $770 not that long ago. So what that tells me potentially, and I don't know the people who did it, and I'm not criticising because it is difficult, but certainly what that tells me is potentially those factors weren't understood by the people who were evaluating it or appreciated by the founders. Well, I put this slide together last week. I didn't know how bad this would get. What a shit show. Last week it looked like it was a play by a rival to disarm and overtake a business. Well, that Pac-Man didn't even eat it. It was that bad. Now we've got a founder who's jet-setting across South America, apparently trying to evade authorities. It's an absolute mess. The fact of the matter is there was a lot of very powerful and very prominent people who put a lot of money into that business. If you lose $80, $90 billion in a week, and then it's come out now that the balance sheet is potentially the most over or underdone balance sheet in the history of a billion-dollar business. These are all factors that are going to play in, and certainly crypto. It's certainly not a slam on crypto. I think the fact that when these things happen, it's actually affecting the perception of crypto and what could be continue to be very good. And then Twitter. Well, you have to be under a rock not to know what's been happening there. Elon Musk walking in with a sink, doing different things. Now, Elon, rightfully so, is idolised by people today on how he operates a business. But what he is very, very smart at manipulating how people think about different things. And I don't know, in all of the social media buzz, if people caught this last week, but Twitter actually put in to be a payments company. Now, in my mind, that means WeChat, right? So, in China, obviously everything's done on that app. If you travel to China, you can't not have that app. Everyone communicates, everyone pays, everything's done. If Twitter's going down that path, that's going to have a massive difference to everyone in this room. And it's something we should keep an eye on. But, as always, a precursor. As he says, they'll do a lot of dumb things in the coming months. They'll keep what works, and they'll change what doesn't. That's a great mantra to live by. And certainly if you're a startup, don't expect that what you do every time. You will pivot your business many times and feel comfortable doing it. The reality is what you've got to do is just make the best decision you've got with what tools you've got in front of you at that moment. If everyone's familiar, I'm not sure if everyone's familiar with the term, obviously black swan and grey rhino. So black swan event is something that will happen out of the blue, not unexpected, will completely change markets, potentially collapse the economy and have a significant impact. Grey rhino, kind of the opposite. Everyone knew it was coming, everyone saw it was coming and just chose to ignore it. And now it's just come through and just cleared through everyone. So, as startup founders, I've got to say, I've thought about it and there's at least 8 things that have happened in the last 2 years. You'd expect one of these every 5 years, maybe 2. There's 8 happening right now. that could be deemed in this category. You've got Brexit, you've got the outcomes of the pandemic, you've got global energy crisis, you've got political and monarchy unrest, you've got Ukraine war, inflation, tech stocks, workplace changes. These are all massive things in isolation would be huge. So, whilst we're reading these things and we understand recession, we're hearing all these words, just appreciate that everyone who's sitting in this room, firstly, congratulations for coming along and trying to speak to people and gathering with people and learning. But most importantly, the fact that we've all still got businesses, with all of this happening, this is just the UK. This doesn't take in supply chain or currency issues or anything globally. This is just the UK. It's very impressive that we, as founders, as business owners, as investors, are still functioning under these circumstances. Now, if you're in a VC, if people understand the VC model, you're looking 7 to 10 years ahead. That's going to be very difficult with all of this is happening. We don't know what's coming next. I might have to make this slide longer next year. So just looking from a true attitude perspective, investing during uncertainty is obviously one of the key things, certainly for investment, anyone in investing in this room at the moment. We were fortunate in the fact that we came from B2B SaaS. That's kind of where all our investments went. During the pandemic and during this period, we've had a really good time with our portfolio, and it's because we invested into B2B SaaS. Now, the key there is, while people were locked up, people were isolated, teams were reduced, you couldn't hire as many people because money was a bit tight. Automation tools and collaborative tools were key. And that, because of that, companies like Figma, which I've got the logo there. So if you're aware of Figma, Figma got purchased by Adobe for $20 billion this year. That was about 100 times revenue. Now, that absolutely bucked the trend on what was happening in the market at that stage. But Figma did all the right things. They approached the right people. They sent out signals. They threw shots across the bow at Adobe that they were going to potentially start taking clients. And it made sense for Adobe to do this, way above value of what you would expect. But they had great recurring revenue, and 200 million ARR is nothing to sneeze at. On the other side, and I know Steve touched on it, with the buy now, pay later, Klarna suffered in the opposite way. Discretionary spending is down. The money was spent when people were sitting in their homes for e-commerce went off the charts. Having been in e-commerce and logistics, I know a lot of those companies have struggled to recoup, to anywhere near where they were during the pandemic. And Klarna, in the past years, they've done an 84% down round, which is going to hurt anyone. So looking on the horizon, I'm reading a lot about dry powder. This seems to be the thing, everyone's dry powder. Obviously it's enthusiasm, but there's going to be a whole lot of money opened up. And if you looked at Decibel Partners and their 10-year study, they're assuming just in the US, there's going to be about $290 billion, which has to be spent. Now, if people understand the VC model, you have to spend the money. You've got the money, you've got to spend it. That's how you get paid. One of the factors there, but, is that you need to get good valuations. So the last 12 months, with valuations all over the shop, very difficult to deploy that money. So it has been a bit quiet, and we're talking to VCs every day. We know that. Looking at the past year, what happened? Like this graph, when I saw this, I thought this has to go up. The difference in spend in 2021 is absolutely insane. Now, there was a number of reasons there, which we'll sort of get into, but effectively, European technology has never been more valuable. If you look at the Europe versus America for a long time, it was never a comparison. It's getting a lot closer. They're starting to make up ground. And looking at that unicorn status, now, do I believe all 84 of those are unicorns, or were they just priced that way? Well, probably not. I doubt there's 84 unicorns. There's going to be a few there with horses with horns stuck on their head, but there's definitely a marked increase, and interestingly, 13 of those are in climate tech. So that's good to note as well. So some valuations that raised eyebrows, and I saw a couple of eyebrows go up. Okay, so this is a global thing. This wasn't just US, it wasn't just Europe, it was everywhere. So dog walking business, $300 million from SoftBank. I think they were valued around $650, $700 million for walking dogs. Now, they are in 4,000 cities in the US, but it's a dog walking business. So it probably was not at the top of the list for what most people would think. Their valuation is pretty close, if not below that now. So obviously that investment has been difficult. Gorillas, this is my go-to. I love this one coming from the logistics side of things. 2.1 billion it was valued at for delivering candy bars in 15 minutes. They're currently, if rumours to be correct, about to be sold for about $100 million. So you sell a business for $100 million, I think a lot of people in this room, as me included, would be over the moon. But if you invested at 2.1, not so happy. And then the final one, my creme de la creme, we did touch on Afterpay, Steve's thing. Afterpay, 29 billion sale to Square. So a year later, that on the balance sheet is marked down to zero. So Square is now worth 29 billion, based on when I last looked at it. I could be wrong, don't quote me. But effectively, it's worth nothing. That might be the best timed exit I've ever seen in business to get out at that moment. So my team, some of them sitting here, part of our business is to get out and talk to VCs, and we do that on a daily basis. In the last 3 months, we've spoken to approximately around 330 VCs, and we've been involved in around 50 fundraisers with clients this year. I wanted to touch on some of the things we've learned about where the market's at the moment. There's a shift from growth at all costs to revenue-based valuations. So last couple of years, it's like, yeah, just get big, someone will buy you, someone will spend money, they'll give you money, go. Well, now they're not. The reins pulled back, and now you've got to find revenue. That's fair. You should have revenue in a business. You shouldn't be just raising money, but do I think it's fair the way that it was portrayed a year ago to a founder to now? Probably not, but you've got to move with the times. So we've got to make definitive moves to meet investors' expectations, and the expectations are there. I'd say fundraising rounds are taking longer to close. Part of that is you've got to start considering whether you start a bit earlier than you would have. I know it's difficult at the moment because everyone's saying, well, valuation's down, I don't want to dilute, but the opposite isn't great. I did put that big, dam there of all that money. There's no guarantee that deploys next year. You might run out of runway. There was a business I read about last week that had 100K MRR, good customer acquisition cost, and was borderline profitable. They just ran out of time and they went under with that sort of thing. Now, a year ago, people would have thrown money at 100K a month, MRR. So there is an issue there. The way that I would approach it, potentially, if you don't want to dilute or you think that your round would be better next year, maybe start a bridge round or start talking to your existing investors or people in your investment network. What I definitely would do is spend a lot of time talking to investors. You don't have to get money out of them. You've got to know what's happening in the market. Not that professional, but I do love this picture. So, in my mind, this is potentially giving 2.1 billion to a company that delivers candy bars, and this is probably trying to raise 500K on a pre-revenue seed round now. So that's definitely how the market has changed. The valuations have changed remarkably, and just because someone in your industry last year raised at a certain amount, don't assume you might have a better business, you feel you've got more happening, but don't assume. You might be chasing ghosts. And if you're chasing this valuation, you may never get it. And once again, you run out of time. One thing is very important, having spoken to all VCs, is EBITDA positive. And having good revenue in your business is now more important than it was 12 months ago. Should have been important the whole time, let's be honest. The company's fundraising has increased exponentially. 5.4 million companies dropped into the global market in the last year. Now, that was off the back of people sitting at home, having opportunity to start businesses, thinking about what they wanted to do. Potentially, there was a lot of layoffs because of the furloughs, etc. And this has resulted in a lot of very good startups, but a lot of them. So it's a buyer's market now. Like we speak to a VC. Previously, they were thinking, should I get into a market? Now they're saying, should I pick from these 4 companies that are presenting me pretty much the same business? Now, what that means is there's going to be 1 that will be selected and 3 more we've got to go and find more money. So the one thing that happens when it is a buyer's market, and putting my founder's hat on, is that you've got to protect against unfavourable terms. Liquidation preferences, control your business, overarching. These are the times when you can potentially be at risk because you need the money, they know you need the money, and there's a glut of other opportunities. So just make sure you protect your business because at the end of it, you still want to be in control of it. And just finally on this, a split focus. So, there was a lot of money thrown at a lot of businesses by VCs. Tiger Global at one point was doing one investment a day. Tough to do due diligence on that. They lost 17 billion first quarter this year. So, these are what happens. But what is ringing true from everyone is the fact that VCs are looking to prop up their existing businesses a lot more. Going to market and with a potential down round is going to dilute the founders. There's more likely those founders lose interest or can't sustain the business. That's not good for someone who's invested into that business. So there's going to be a lot more of the percentage of their funds allocated to follow-ons. Not great when you're trying to raise money, certainly when you're trying to help companies raise money, but it's a fact of the matter. And let's be honest, that's a good thing. They should be helping them, that they've already committed to them. Now, just the final bit, just to cover my predictions for 2023. So looking at, I believe there will be a lot more unicorns in Europe. I think the unicorns will be a lot more financially stable. I think they will be definite unicorns. I think they will be in areas that we've never had them before. And I think that's a great thing for the market. High net worths, if, as we're saying, and the indications point towards a recession, high net worths are going to be a lot less cash in the market. So we've got there, and the third point is there's 5.4 million businesses now looking for cash at an early stage, and you've got less cash in the market. So there's going to be a lot more of a feeding frenzy. What you've got to think if you're in this room now and you've got to raise, your seed at the moment, or family and friends, is you've got to start thinking about how much you actually need and don't overspend very early. You need to have enough cash to be able to sustain this because you can't just walk up to someone and get a check anymore. I believe female funding will continue to increase. I've seen already there's a number of VCs popping up in Europe dedicated to female founders. I myself have invested into a number of female-led businesses, and I'm very happy to see that that's going to continue. The crypto side of things, FTX, Luna, about 5 others. There's a start to, and as with any business, the business area, these will start to, peter out and stop being so significant. The difference with most business areas is that every time they fall over, they don't take down 70, 80 billion. So, that's one thing where the governments are going to have to step in. I know that's a big thing, speaking to anyone in crypto, that, it's got to be isolated and the government's going to mess with it. Well, maybe they should, because, quite frankly, there's a lot of significant people lost a lot of money. Sustainable investment, I think every VC at some point will have this in their thesis now. As I mentioned, 13 unicorns have come from climate tech and clean tech in the last year. This is huge, and towards those 2040 targets, there is a huge opportunity for founders to get into that space. And we're seeing a lot of that now. There's quite a few companies in our portfolio that we're working with that are in this space. And you know what? They're all doing pretty well. We've spoken about the valuations, funding choices. You don't have to dilute. You don't have to take equity every time. There are other options available to you. There's more than there's ever been. Whether it's venture debt, revenue-based financing, there's a lot of things to look at. More than happy, obviously I won't get into detail here, it's not really the forum, but more than happy to discuss that with anyone at any time. So that's me for today. Hope everyone enjoys and hope it was informative. Thank you.
My name is Steve Torso. I'm going to be the host or the moderator for this panel session. This area of clean tech and sustainability and just effectively climate tech in general has been something interesting to me. I was just telling the guys, we actually ran our first clean tech showcase in 2010. Do you know how hard it was to get people to a clean tech showcase in 2010? Incredibly difficult. What's been fascinating for me to see over the last sort of 2 to 3 years, how much money's been invested into this space, and it goes a lot to what I talked about in my presentation earlier, is it's now just become such a viable option because of the low cost now. It is the now cheapest form of electricity. And the other part with that, there's so many innovators in so many areas coming up with different solutions. And today we've organised an incredible panel session covering the different areas from investment to consulting to build to the founder side. We want you to understand from each perspective. So as a first step, can I please welcome William Rowe, who's the founder and CEO of Octopus Energy. Please come up. Marion, who's the Managing Director of GeForce, please come up. Peter Bance, the founder and CEO of Origami Energy. Stephen Murphy, who's the Climate Tech Consultant, please come up. Lawrence Campbell-Cook, who's the CEO of Pavagen Systems. All right. Okay, so as a starting point, can I just get everyone to just give starting with yourself, just please give an introduction to yourself and also what you do.
Perfect. So my name's Lawrence, founder and CEO of Pavagen. We make floors that convert the weight of your footsteps into energy and data. You may have read in the Metro this morning that we just powered part of Telford train station, and we're using the energy of people walking to charge mobile phone outlets there. It's all plugged in. But we're all about bringing ESG to life, making it fun, making it really engaging. And we've hit 100% revenue growth this year. We're backed by the two richest men in the UK, and we're really excited to be here and talk a bit more about sustainability and the future.
Fantastic.
My name's Stephen. I run a small advisory business called CTC Advisory. I work as basically a climate technology consultant. And for me, climate technology, very hard to define, but quite overwhelming. Everything from nuclear fusion to cell-based food to decarbonization of oil and concrete. And delighted to be here. I used to work at Founders Forum, where I ran a community of about 1,000 founders, investors, policymakers, and media. And I'm particularly interested on the connection between founders and policymakers and how to basically educate policymakers on the technologies these innovators like Lawrence are coming up with. So great to be here.
Hi, I'm Peter. I'm the founder and CEO of Origami. The kind of light bulb moment for me when I'm actually sitting in a London-based investor called Octopus, actually, ironically, as entrepreneur in residence. And they were piling hundreds of millions into technology-based ventures and billions into large renewable-based assets, but basically nothing in the overlap. And I thought, aha, let's go for it. So really what I did was found a company that was trying to be the digital glue, the digital infrastructure between the physics of energy assets and the economics of markets. And really that's what's become Origami.
Good afternoon, my name is Marian Gestik. I'm a partner managing director of GeForce. GeForce is an early stage climate technology fund. We started last year, finished our first fund, and now we are starting to invest from our second fund. We invest in early stage climate technology companies anywhere in the world. We invest globally.
Hi, I'm Will, CEO and founder of Octopus Hydrogen, not Energy. I just need to clarify that is someone else. He's a great entrepreneur called Greg. So we're a hydrogen developer, so we build green hydrogen production facilities across the UK. Typically, we build it next to a wind and a solar asset and then use that hydrogen to try and decarbonise applications that can't be done through direct electrification. So things like heavy goods vehicles, planes, and also getting rid of a lot of what is grey hydrogen, which I'm sure will come up at some point in the discussions. And we also have a software business that effectively helps other project developers be able to minimise their cost of power and therefore be able to produce the cheapest possible green hydrogen.
Fantastic. So Lawrence, going to kick off with you. So you just mentioned straight off the bat that you actually avoided VC money and you actually had two sort of very wealthy people invest into your round, two of the richest men in the UK. Why was that a strategy from your part, and how do you see that as a difference for the building of your business?
Yeah, so Pavagen is a hardware company, right? So we have a unique piece of software that sits on it that we built recently that is giving us that SaaS platform. But we all know that VCs are really focused around that recurring revenue piece. So we thought, well, we know that it's not the most appetizing thing where they can see, a group of 10 people scaling to $1 billion. But what we saw was the value of we are in the built environment. So we sell to shopping malls, real estate developers. Our biggest market's Hong Kong. We've got some developers there that are coming back 4 times, 5 times, 6 times to keep buying PaveGen for their projects. And we thought, well, if we can get these strategic partners, not only will they be buying our product, they'll be investing, and then they'll give us strategic support. So, for example, the Hydija Group, they invested, and I didn't realize it until I got to know them, is they actually do all of the value engineering for Nissan and Aston Martin cars. So when a UK designer does a nice swoosh for a car, they send that drawing to Chennai, and there's a team of 500 engineers that will do all that value engineering, all the heavy lifting to get it tooled up. And we went to go and see these guys, and now we have a team of 12 people there doing all of our industrial design and our engineering for production, and it works really well, because if there's ever a problem, we can phone up the Hydija team, and they kick everyone, and then they work a bit quicker and help us. So we've got this great relationship where they're actually helping us, because also, when you get an email from PaveGen and you're a huge factory, you don't necessarily get as excited as, I guess, Apple and Foxconn, their relationship. So having someone like Hydija send the emails means that some big investment casting companies say, hey, look, yeah, we'll deal with you guys, and then we work through them that way. So I think we've been really lucky with the Hydija Group. We've got the CEO of Joan Lang LaSalle. He's invested, and obviously, as the largest real estate advisory firm, it's amazing to have that kind of partnership together. And then finally, we brought on a strategic investor called Jeff Martin. And Jeff Martin was head of multimedia and entertainment at Apple, working next door to Steve Jobs. And he realized, he said, look, PaveGen, you found a way to suddenly get engagement from people in cities. It doesn't work scanning people with beacons. Billboards don't work, but PaveGen is this beacon for sustainability that allows people to take part in it. And because he saw outside the White House that there's a PaveGen there now, and someone just jumped up and down all day long. And me and him sat there and were like, are you okay? Why are you just jumping? And this guy's like, I'm powering my city. I'm making a difference. And yes, it's a small difference, but we both realize that this is a way to captivate young people and old people around the power of sustainability. And there's never been a more powerful time than now. So we've been lucky to have all these partnerships that are not only investors, that go way, way beyond that.
Was that person tested for chemicals as well?
Well, I didn't go that far to do a blood test, but...
Okay, so Mario, on the other side, obviously investing into this as an area is obviously risky, especially at the early stage. So for you, what are you looking at? Given the risk is especially high, what are you looking at in founders? What are some of the early things that you're looking for as companies are in the starting phases when you're investing?
It's a very good question. We apart from the timing you mentioned earlier in your presentation, timing is very important. When it comes to founders, there are two key things which we look for, and this is expertise. And the second and most important one is being mission driven. Because if people are money-focused, money-oriented, then they're going to give up at some point.
Yeah.
But if you're in it for the mission, and climate tech is a big mission we have to have to save the planet. That's a very important aspect we need to have in those founders, apart from them having a great tech, having a great team, but being mission-driven and just not giving up and taking the company all the way. And having global ambition, those are the key things.
But there must be a timeline that you're thinking about. Like when you're investing into a technology, you must be sitting there thinking, okay, I expect for this technology is going to be a period of 5 to 7 years of investment before we start seeing the revenue or return. Or how are you approaching it?
Well, we are unlucky and lucky at the same time that we have one of our main shareholders is Founders Factory, which is a company from here, from London. They have about 300 companies in the portfolio, and what they do, they employ over 70 experts of startup building. And these experts, after we invest, we then put 5 to 6 people on each company for about 6 months. And we can only invest in companies which can absorb the help we can provide. So this is why we don't focus on areas like nuclear fusion or lab-grown meat, which still need about 4, 5, 6 years in the lab to make it work and be market ready. We focus on areas which can prove some results next year. So our first company, for example, had last year revenues of 100,000, 2 million this year. They aimed for 20 million next year.
Wow.
The second company invested 6 months after us at 5x of our valuation. So climate tech is now really, the timing is perfect for climate tech. And we can only invest in companies which can really absorb the level of help we can provide.
Yeah. I think the really nice thing for all of you is if you think about it, there's obviously a corporate force in the desire, the need to be ESG. Obviously, there's becoming more, I suppose, criteria around that. You've got governments mandating in different areas, and then you've got consumers that are wanting to buy it. It's actually very rare that you have all those three elements working at one time in the favour of an opportunity. So I'll come on to you. The biggest challenge, obviously, for renewable energy is pairing wind and solar with another source of green energy to take up during the slack time. Can you provide just a bit more detail about what you do at Octopus Hydrogen and how you're addressing the slack times?
Yeah, so I guess I like to think of the problem the other way around. So, as we all know, the wind and the sun are not available all the time. But when they are available, they're typically in abundance, and therefore the power that comes from them are very cheap. So the way we look at it is, great, build as much wind and as much solar as possible. They are already the cheapest form of power. We do that, okay, then we're going to have periods of excess. In those periods of excess, what can we do? Well, we can charge cars smartly, electric vehicles. We can start to use heat pumps in people's home and provide them with power, for heat that's cheaper than gas is today, much cheaper. We can start to have, grid-scale batteries that can take on board that power and then discharge it, when people come home and they need power. But there's also kind of an extra bit we could do, which is use something like green hydrogen. And in that example, we can take, the excess wind and solar that's cheap. We can make a molecule that can be used for things that can't be electrified. So the beauty of hydrogen is you can combust it and there's zero CO2 released. So the only byproduct of combusted or fuel cell-based hydrogen generation of power is water. And so all of a sudden we have this kind of molecule that could be useful for all the things where we're not going to feasibly go down the electric route. So you take something like aviation, a plane, if you filled it with batteries, wouldn't go anywhere. So, the probability of having viable medium and long-range electric aviation based on current battery and even non-commercialized battery technology is basically zero. So we only really have two options. We either create a liquid-based fuel that's going to be effectively a synthetic version of what we use today, kerosene, or we're going to use something like hydrogen. And there's lots of things like that, whether that be HGVs that deliver, food to supermarkets, whether it be long-range shipping that delivers, goods and services around the world, all of that kind of stuff is exactly the sort of thing where we see hydrogen playing a role. And then there's a whole sort of second degree of things that, could be relevant, whether it be what you do when the wind and solar isn't generating. You could, in theory, take hydrogen that's been produced and use that to generate power. Now, the efficiency of that cycle is not perfect. You lose roughly 50% of the electricity at the start if you go down that route. But equally, if it was very cheap and abundant at the time, it's a lot less painful than, for example, using fossil fuels. So it's a really exciting opportunity for us to be able to sort of say, let's flip the problem on its head and say, wind and solar are going to be super cheap when they're in excess, and let's use that for something really valuable.
Fantastic. And Peter, I'm just going to go to you. You mentioned before about the digital glue between physical assets and dynamic energy markets that sort of Origami was built on. Can you just provide a bit more insight to that? Because obviously there's a lot of hardware when it comes to sort of climate tech and so forth, and then obviously the role that software plays in, I suppose, enabling that hardware.
Yeah, I think there's been a major shift, especially in this kind of post-subsidy world. When you were building out still relatively small amounts of solar, wind, grid-scale batteries, EVs, you name it, the green electrified world, when it was sort of in the noise, you didn't need to be too smart. The systems could just suck it up, et cetera. And also the way that markets work, the world of money, whether it's trading in wholesale markets or balancing grid systems, again, it wasn't actually that complicated, or any technology that was developed was locally sort of optimizing that one pool of value. But when the amount of green energy becomes a material fraction, 30, 50, 70% of energy systems, and things like wholesale market volatility starts going really big and managing physical grid systems becomes much more challenging, then there emerges the need and actually the opportunity to build a whole new independent class of technology that isn't bolted onto the battery or the EV and isn't bolted onto the trading desk. In other words, a genuinely independent layer of digital infrastructure that you can put in the hands of the solar developers, the wind developers, the grid-scale battery operators, so then they can plug in whatever battery management system or inverter is flavor of the month and whatever route to market or trader happens to be contracted with them. And that becomes a layer of independent digital infrastructure. And in fact, recently we signed a 20-year SaaS deal with one of our customers. So they're taking a long-term bet that technology, one way or another, is going to be essential to the monetization of the underlying green project, not knowing what pool of value or what piece of the supply chain they're going to procure. They're just going to plug it in to this piece of digital infrastructure. So that gives them the power and the control and the visibility of what's going on, and gives them the optionality in the future to work with different routes to market or different sources of physical supply. So that's been really the big shift in the last few years, and I mean the last 2 or 3 years, is this kind of new category emerging around independent digital infrastructure into which you can, open by design, plumb in different routes to market, different trading desks, and different OEMs and different battery management systems, for example. That's a new category that we're pioneering.
Fantastic. And over to you, Stephen. You've just returned from COP27 summit in Egypt. What are the macro trends that you see emerging in this space after that conference?
Yeah, so COP27 is still going on, actually, I think, till the end of this week. I attended for 4 or 5 days, got back on Saturday night. Really amazing opportunity to meet with leaders from around the world, people from corporates, investors, innovators. So worthwhile to be in person and have plenty of panel sessions, but also that kind of like networking around it was a great opportunity. One of the big trends, obviously, and look, we're at an investment conference, it's all about following the money. And there was various pledges made, but actually, in advance of COP, obviously President Biden had the IRA passed. They estimate that unlocks about $400 billion of spending on climate technology. But actually, there's other estimates which say it might be double that, up to $800 billion, because the incentives are uncapped on things like electric vehicles. And that money will unlock private sector money. So it could be, over $1.5 trillion of new climate spending. So that's obviously one big trend. And the other big trend I see, and we see it here today, is the people working in climate technology now. And someone said it was kind of akin to the movie The Social Network, when kind of like working in social media became cool. But now we see these people working in climate technology. So there's innovators here, or people I think of. I spoke recently with a 22-year-old in New York who has patents for modular nuclear fusion small reactors. Actually, I think I met him through Marion. Or a client of mine is a 21-year-old synthetic biology founder. He's raised $15 million. He's creating enzymes that eat plastics. So those trends, I think the money, which we're here to talk about, but then I think about how to channel that money to these innovators. And often there's a lack of, I guess, education. I mean, I'm not a scientist, so I don't necessarily understand the science of these things. But when it comes to investors and to policymakers, I think it's really important to how do we focus on educating these people? And then my job is to get the innovators in front of them in formats like this, or even smaller roundtable sessions, private dinners, that kind of thing. So, yeah.
Well, speaking of education, obviously, Lawrence, just be curious, when did you actually start your business?
So we became commercial in 2015, 2016.
Okay. What was the education process like for you? Because I imagine when the early days when you were going around talking about this as a business, I imagine you got some sort of strange glances to start with. What was that process like? Yeah,
totally. So I think, it started off, I was an engineer at E.ON, and they asked me to build a solar streetlight. And I failed to find a way to make solar streetlights work in dense urban environments. They fired me. So hanging my head in shame, I'd left E.ON, I was depressed, I thought my life was over, and I thought, hold on, if I can't make solar work, what else can I make work? And then I came up with this idea for, hey, what about a floor that would generate energy? And in those days, I think like the head of sustainability, it was like a dirty word. They were like locked in the basement, no windows. They were only asked to come up once a year just to give like 4 lines in the corporate report. And I think what's so interesting is now you've got like Steve Varley, CEO of EY. He quits as CEO and becomes head of sustainability. The CEO of JLL quit to become head of ESG, because these guys all realize that suddenly they've got to leave a legacy. Actually, it's not about making money. It's about doing good for the world, leaving the world in a much better place. So I think what we're seeing now is everything's come together. We've got the clients, the corporates, you've got the public. The Greta effect has been the most important wave that's crashed through this industry, and that people have to make a stance for climate change. And you see just with everyone closing the roads, and although it's annoying, you are seeing young people in tears because they realize we've got to make a difference. And I guess it's up to people in this room to like stand up for climate change and don't invest in fossil fuels and invest in the people you see in front of us. To really make that change. So I think it's never been better, and that's been reflected by, we're expanding like rapidly at the moment because.
Well, that's the other part. The economics of it have became where investors actually want to participate and get behind it. If you typically look at the stages in new areas, governments have to fund it to start with, and then the commercials sort of come in. But as I said, those 3 different forces where not only the value, the cost to actually execute has come down so much, but those forces of the corporate requirements, the government funding and mandating, and plus just that actual desire for people to want to make a difference.
And also energy. Like, did we ever go to a dinner party with our friends on a Saturday and talk about our energy bills? No. But now everyone's talking about it, and it's become like a real deal. That obviously it's because of the money of it, but actually this all has a trickle-down effect. You know, I might have spent 2 hours in my loft insulating the pipes, and although I'm a sustainability person, I've devoted my life to it, I didn't think of doing it until it really made a difference. And now everyone, it's a big deal for all of us, and I think that's so important. It's all come together.
Now, Marion, the question that every other investor wants to know, this is obviously a big area. How do you pick where you're going to focus on?
It's not easy, but there is an easy way of thinking about it. So there's plenty of areas which might not seem so obvious, like construction is a big area. There are some less obvious ones like food waste. Food waste is about 6% of global greenhouse gas emissions. There are areas where methane is about 7%, just methane alone. There's plenty of methane leaking in all these natural gas pipes or wells which are abandoned, leaking all the time. The way we see it is we don't try to see and look at different areas. We see where a direct impact is on lowering global greenhouse gas emissions. No matter which one, CO2 or methane or NOx or some other gases, any direct impact company which has a scalable technology and can have a global impact fairly soon. That's how we see that.
Got you. Now, Will, for you, I imagine when you're you're obviously focused on green hydrogen as an area. I imagine that I suppose the other competing areas for this money would be, obviously nuclear has become part of the discussion right now, and then obviously we're talking about battery storage. How do you describe the sort of benefits of green hydrogen over those two, I suppose, alternatives, or the different application in which it gets used?
Yeah, it's an interesting question. So I guess, look, take a step back. Where did power grids come from years and years ago? So you had centralized, typically fossil, typically coal-based generation, and then you had the odd bits where there was a heavy degree of hydro, say the Nordics and northeast states, etc. But it was typically, burn lots of coal, generate power, and generating that power rather than people having coal in their homes was a superior kind of way to distribute energy. So it was a net benefit from a kind of clean cities perspective, but from a climate perspective, it was pretty poor. And then you kind of then switched coal into gas, and then nuclear came along, especially in places like France and stuff, and the US, where they were like, right, great, nuclear is something that we can run centrally, so it ticks that kind of generation box, and it runs at a baseload level, so it's 24/7 clean, green energy, so there's a benefit to it. The challenge of it is, in reality, nuclear has never been delivered for less than a kind of £100 a megawatt hour. Well, solar at the moment is £10 a megawatt hour to build in the Middle East, and it's about £30-35 a megawatt hour in the UK. So, renewables, onshore wind and solar, are less than a third of the cost of nuclear. So you've kind of got to make the decision, which is, okay, you want energy all the time and when you need it, but our demand is not 24/7 the same. And then at the same time, how much are we willing to pay as a premium for having certainty of generation all the time, which is effectively what nuclear is. So the way I see it is you'd always build as much wind and solar as you can because they're the cheapest. Then you build some nuclear because it makes sense to have that backup. And then you use things like batteries, green hydrogen, demand response, things that let you flex the shape of your demand and supply to kind of fill in the gaps. So, certain countries went down the other route. France is basically 100% nuclear. And, if it wasn't for huge amounts of state subsidy, that would not be viable. You've got other countries like, right now China builds more coal every day than anywhere else in the world, but it also builds more wind and more solar. So it builds more of everything every day, and they're trying to build a dynamic system. And they also build more nuclear. So I guess the point being, I think all of it, getting rid of the fossil fuels, whether it be nuclear, wind or solar, makes sense. And it really comes down to, we have the technology solutions now to be able to handle demand and supply imbalances from an electricity perspective. So you probably don't need to pay the premium just to have that certainty all the time of nuclear. We can leverage those kind of cheaper excess periods better, and then use nuclear to fill in some of the gaps.
I think it got described to me last week when I was doing a podcast, and one of the challenges with nuclear is there hasn't been a nuclear power station delivered on time or on budget ever.
I think the big thing that's hurt nuclear as well is they've never gone down the modular route, right? So every time nuclear's been built, it's different every time. So the learning rate is just incredibly low. We haven't built enough of them to compound any kind of learnings, and each one was different. Whereas the reason why solar's become so cheap is because, you build a panel that's no bigger than a floor tile, and you can build millions of them, so you get a huge learning rate. And so I think that's a key thing, and one of the things we focus on with hydrogen is saying, how do we push the learning into factories where they can repeat the thing more and more, and not push it into kind of, what people do actually in the field where you're building it, because the guys in the field are not the ones who need to learn all of that stuff. We need factories to learn how to do it quicker and cheaper, and then people in the field just install it and commission it, and off you go. You don't want bespoke engineer in every project.
Yeah, makes sense.
Steve,
Okay.
can I jump in there? I'm
No,
just
you
curious,
Just go, yeah.
yeah, please, to ask William actually, because I've been reading about a startup basically, but it needs $20 billion of funding to bring
I've
in.
not got that check.
Good luck raising that.
You might have heard of them. Building solar in Morocco and importing it via cable to the UK.
Oh, X-Links.
X-Links.
Octopus has backed that.
X-Links. Okay, so Octopus backed. I was just curious if you had a viewpoint on it.
I think it's
amazing.
basically
Obviously a positive one.
It's a massive wind and solar array with a big on-site battery in Morocco, and then I want to say 3,000 kilometre high voltage DC interconnected to the south coast of the UK. It's a fantastic project. Some of the technical challenges are quite large. Like, it's the biggest. You have to build a new ship to lay the cables, and two new factories to build the cables. So it's quite a big challenge. But yeah, I mean,
it's an amazing example or a case study of innovators talking to policymakers and to unlock, because what they're saying is that they'll get private sector funding for the 18 billion if the British government commits to buying the energy at a certain price.
Yeah, which is about £40
cheaper than
a
nuclear, but
megawatt
more expensive than solar, I think. But
it's about £40 a megawatt hour, but then it delivers 20 hours of power every day. So it's a good project.
So Peter, I'm just going to come on to you. So you mentioned Lawrence mentioned about how people are now suddenly talking about their power bills, and we've sort of got understanding as to why. So does technology, give you that flexibility as far as to be able to price certain historically offered during long-term power deals? I think you mentioned about your SAS deal. Give us some more insight into that.
Yeah, I think up until fairly recently, if you're trying to make a green project more bankable, whether that's bankable in terms of the return for the equity or literally getting more debt into the capital structure, you relied on commercial instruments, power purchase agreements with hard price floors, or AAA rated paper behind the offtake agreements. But if you're in the world of merchant risk with value flying up and down like a yo-yo super fast, then actually there's a different way of thinking about the whole bankability question. So instead of trying to take the risk away with a hard financial instrument, which you will pay for, right? Through your commercial wrapper, there will be a significant premium to pay for someone else to take away the price, volume, or shape risk in those offtake agreements. Or you can say, listen, we know there's going to be money to be made somewhere, just not quite sure where. So lock in a layer of technology that lets you hook into whatever value pool is flavor of the month or the hour, and get ready to basically hop between those pools of value. So it's a different way of establishing a price floor, not using a hard financial instrument, but using the digital layer itself, getting ready to exploit whatever pool of value comes, whether it's raging volatility in the traded markets, as has been happening over the last year or two, or it's the challenges in balancing grid systems physically and the likes of the systems operators paying you to fix their problems, or even locational constraints in networks as well. So the new normal is that there will be money to be made in addressing these valuable pools, whether it's trading or constraints or balancing systems. It's just that nobody's got a good crystal ball about exactly which one. So rather than try to have a pricing mechanism to take away that risk, you can actually use the certainty that technology gives you and get ready to hook into whatever value pool comes. I think that's a mindset shift, and it's beginning to happen. And I think, interestingly, talking about following the money, which I'm as a North American, I'm a kind of a big believer of it, is that if you look at the infrastructure funds piling into this space, whether it's Canadian pension funds or Aussie or British, is that there's beginning to be an interesting and I think really quite compelling marriage between the kind of the trillions going into physical assets and the billions or millions going into the enabling technologies that either de-risk or enhance the returns from that gigantic pool of infrastructure money. So I think there's a really important investment theme, almost a new investable asset class, which is those enabling technology-based solutions that help leverage the wall of infrastructure money. I think that's a really big theme that's going to dominate climate tech.
So just on that, on the infrastructure part, if you think about it, like I know this is one of the big issues with Australia. The electricity grid is what, 50 to 100 years old. And I think when you mentioned about the trillions going into the infrastructure aspect, how difficult is it being innovative or coming up with sort of technological solutions when you're dealing with effectively 50 to 100 year old sort of infrastructure? I'll just leave that open. Like what are some of the challenges that innovators and investors face dealing with that?
Yeah, I think there's a lot we can learn, as a community from previous revolutions. It's not a perfect analogy, but what happened in telecoms is really quite relevant in terms of the infrastructure layer of whether it's the copper or the fiber, but then it's like the new application layer innovations and the ISPs, the way that the energy transformation is happening. There will be some genuine innovations in the infrastructure itself, in the pipes and wires, clever sensing or dynamic routing or whatever, but the way you build applications on top of the infrastructure is going to have 10 times as fast innovation as maybe in the infrastructure itself. So I think we should open up the history book from the telco transformation and learn where there are good analogies and where there aren't. But I think that's a really important difference between innovating literally in the infrastructure layer itself versus the applications on top of that infrastructure. And I think that's where this marriage between different pools of capital have different roles to play. They're both relevant, and actually they can work together really well.
So I'd love to get anyone else's comment on that, but I'll just make one other comment. You said about following the money. The other part that you mentioned was really important about following the talent as well. Those two aspects make such a difference. Anyone else want to make a comment on the sort of working with existing infrastructure?
I can give an example. There's a company in our portfolio which is doing a flexible solar, which is cheaper, lighter, slightly less effective. So they have a small arc. You can put it outside of your house, and that charges your car. You don't need to connect it to any grid. It can be independent. They have another product which they are now testing at the airport. It's a small arc, and it's over a parking space. So you come with an electric car to the airport. It charges your car while you're away. It doesn't need to be connected to the grid, so you can have some solutions which are independent from the grid. So even though the grid is old, needs to be refurbished or renewed, there are ways how we can use existing technologies which can not drain the grid and help the grid get lower in terms of capacity.
I suppose green hydrogen has that potential as well, as to be able to be retrofitted to existing sort of power stations.
Yeah, I mean, you can't underestimate how much energy is used for a lot of things you kind of don't think about day to day. So, you take your typical house and, your energy demand is actually relatively modest. You boil a kettle, you've got a TV, maybe an oven. It's not a huge amount of power you use every day. It's very, very modest. And then your car, on the other hand, would probably use, I've got an e-tron. My car uses about 30 days worth of energy every time we drive it 100 miles. So to put it into context, so driving your car every day is like increase it, 30 new homes being built. So that's like the relative performance that fossil fuels deliver for you. So when you think of it like that, imagine what a HGV uses. Imagine what it takes to heat, an air conditioner building like this. Like the power demands get exponentially much larger. And so what we find is, electrification of some things like HGVs does make sense. You see battery trucks, you may well have seen the Tesla Class 8, it's like a great looking truck and it's going to be super cheap and go a long way. The challenge is you need a megawatts worth of charging, which is equivalent of connecting about 350 homes to the power grid to just connect one charger for that truck. So the reality is it's exactly where hydrogen starts to play a role. It's not just about round-trip efficiency. It's also about saying, well, we are unlikely to be able to increase the amount of electricity arriving into the suburbs of London where all of the HGVs that deliver our food come from by a factor of 10. We're going to need another way of getting the energy there. And don't get me wrong, we will invest in transmission networks that get power from Scotland or from nuclear sites or wherever, but we also need to have something else. So that's where hydrogen definitely, has a role to play as part of what we see.
So it got described to me that the process for electricity going forward, it starts with solar and wind. Then the next stage is obviously the storage of that energy. Then the next stage after that is the local microgrids. And then the next stage after that is basically the self-fulfillment, the powering of the own home. Really, doesn't that mean for you guys that there's opportunities across all those 4 different stages? And if so, how do you see those opportunities playing out across the next sort of 5 to 10 years from an investor's perspective? Anyone can answer.
I'll have a go. There's to use kind of VC speak, there's B2C stuff and there's going to be B2B stuff in that space that's going to emerge. It's going to be interesting. So the use case for the consumer, whether it's the charge optimization of your vehicle or your heat pump or your solar array in your home, there's going to be sort of demand side innovations and applications and whole marketplaces that emerge in that space. But the systemic level benefits touching the infrastructure that either already has been built or the stuff that's being rapidly built out, I think there'll be a super interesting flurry of both B2C and B2B innovations in this area. And they're going to need to talk to each other. So I think I'm sure there'll be some interesting venture opportunities to invest in stuff which is optimizing the consumer use case, and that also provides opportunities for systemic value upstream. So that is an interesting way of thinking about the world, I think.
I love the idea, Alex. Oh, sorry, go for it.
Well, I think it's going to be done really carefully. So Sidewalk Labs went to go and develop Toronto, and they had this amazing vision of like bins that would like suck in the rubbish, and it would be really sustainable. And they were trying to put a sensor in everyone's home, and people hated that because, let's face it, they were trying to control the energy and optimize it. But really, they were trying to turn it into Internet 4.0 and to monetize maybe how we sit. They might know about what we're thinking, and then start selling advertising to us. And people hated it. And
That's Google and Amazon's job.
Well, yeah, and they had to pull out of that project. So I think that you need to have like a really human-centered approach. And people talk about smart cities and cramming it full of technology, but like people have been shown to be really unhappy with some of these smart city developments that haven't had like people at their core. And I think we need to be really aware of like humans, the part of this, because we're not just robots. We have needs and wants and desires to make a change. So I think that's the part that needs to be, that hasn't really been thought out properly for the next 10 years. Once all these amazing things have come to fruition, what are we going to be left with, the real community, the citizens of this planet?
That, I suppose, leads a question really well to Stephen, is you obviously work in consulting and community building. Just give us a practical example of how this works and how this, I suppose, influences.
Yeah, well, I guess one area, it's not energy, but it's related to climate technology, is food and agriculture, obviously a massive emitter. And I've worked with a number of cell-based food founders over the last couple of years. And one of the big trends has been alternative proteins, so like Beyond Burger and Impossible. And obviously, valuations-wise, they've taken a bit of a hit recently. But the real breakthrough that's coming is the cell-based food, which is already, the innovation has happened. It's for sale in Singapore, cell-based chicken nuggets. But basically, instead of, getting a steak from a cow, you grow the steak in a laboratory using cells.
Any that are delicious yet, though?
The cell, it tastes the same. I haven't tasted it yet, but this is the amazing innovation. It tastes the same health benefits. Without having the emissions from agriculture and factory farming and all those areas. And so it's not a race, because obviously countries are slow to regulate for these things, and policymakers can be slow because it's, these are big questions. But now it's like, will the EU regulate before the US? Where does Brexit Britain come in? And I guess, I'm trying to help on raising awareness with policymakers. So we're looking at Davos now, which will be in January, which brings together all the major governments and corporates. We're looking at doing a food tasting, for example. Can we do that there for policymakers, just to help educate them and get founders in front of them? So that's just one example of one area where there's kind of like people power meets innovation meets policymakers.
I was just I think it's a really important point, though, like across, if you think, you can take a step back sometimes and say, oh, well, our lifestyles are part of the problem and we need to change all of that. And then you've also got to think, well, take the experience with COVID, and as you're saying, you were at COP27, being there in person was super valuable. And often, food is a big part of who we are as people, we often eat socially, etc. And I think what we need to be cognizant of is, there's probably a degree of lifestyle changes that are sensible for us all to make, but equally we need to find solutions that are sustainable. And there's 3 billion people who don't live the lives that we live, that also want to aspire to a more kind of energy intense and resource intense life. And we need to kind of be very sensitive, aware of the fact that ultimately, humans have certain needs, and we can't just say, no one should travel anymore, everyone should just, eat X and do Y, and then we'd be a lot better, because that's not the way we are, right? We need to find a way, and there's a degree of self-reflection, there's also a degree of saying we need to find solutions, which is why I started hydrogen, because I was like, I still want my kids to be able to go and travel to all the places that I was lucky enough to go to when I was 18. I think it's great. It makes you a better person and see the world for what it is. But that's a good thing. But equally, we can't all do that because there'll be nothing left to see. So we need a way to do that sustainably.
And also, our the Western world, we're governed in democracies, so things almost by definition take longer because there's consent involved. It's not, we didn't build hospitals overnight, right, like happened through COVID in China. But it's worth keeping that in mind, I think, for people who are asking for quicker change, that these things will take time.
Yep. So final question for everyone, and this is to speak to the capitalists in our hearts that want to make a difference and make good. If we're thinking about, and we just start from Lawrence, if you're thinking about from an investment perspective across the next 5 to 10 years, what do you see as the greatest investment opportunity that investors could invest in right now? Obviously all the disclosures that normally go along with this type of question. What do you see as the greatest investment opportunity investing into this space for the next 5 to 10 years that investors should be looking at?
I think that this world's full of megatrends, right? We've just seen that this kind of like crypto megatrend has imploded, and every week there's a megatrend. But I think the one thing we can say is that climate change is not just a fad of the month. It's not just a fad of a year. This is a thing that our kids will be, our kids won't be able to go on holiday.
Change.
Yeah, they won't be able to go and see a glacier because there won't be any left, And so I think this is really pivotal, this area. And I guess that's why hopefully everyone's here, is that this is the time that everyone's got to stand up and make a difference. I think that you need a mix of energy solutions. Like hydrogen is probably getting nearer now than it's ever been. I think 30 years ago, people were trying to make hydrogen cars, but you couldn't make hydrogen. But now it's getting real. So you need a mix of solutions. I'm obviously biased that I think that footstep power is a way forward. Now, we're not saying that we're going to solve the world's energy problems with footfall power. Actually, it's a very, very tiny amount of energy that's produced from a human footstep. But when you're a huge corporate or a government and you've spent $1 billion on your solar, $1 billion on your hydrogen, and then you suddenly realize actually people have got to play part in this change. We're that component that is maybe 1 or 2% of the energy mix, but actually it's about bringing people on board with the journey that you've committed to. Not just like a bank telling me the other day who are not so far from here, we've bought 1,000 desks made from recycled plastic. And it's like, great, but no one knows about that, and it was a kind of almost a pointless investment. It's about doing things that bring your community, your stakeholders, your employees all together on the journey with you, and I guess that's why we launched a raise recently, and we're really excited about capitalizing on this huge opportunity that is over the next kind of 5-10 years going forward.
I don't know if I quite got my answer, but I make it feel like the next 5 to 10 years are going to feel good for going into that process. Yourself, Stephen?
So I'm not a professional investor, so I'm wary of speaking.
I said all the usual disclosures. That's already taken care of.
So I am a very small investor in a fund called Voyagers Climate Tech, and they invest directly into very early stage climate tech companies. I think it's a $10 million fund, and they're within the community which they run. These founders are based, and the peers review the founders before the investment is made. So for me, that's quite an exciting to be part of that journey. But I would just say, there's so many funds now which are sustainability 100% focused. I mean, like Marion and GeForce. So that's where I would be looking at, because I don't want to pick the winner. So into a fund and they will pick the winners, hopefully.
Okay.
So without gratuitously waving the origami flag, which I think is kind of boring, not the business, the flag waving, I think the solving dynamic problems is, whether it's through data or physical interventions or whatever, we live in a very high change world, and I think that's just going to keep being true for the next 5, 10, add as many years as you want. So solutions which solve dynamic problems rather than optimize a static situation that happens to be today, I think is going to be a really big deal. So looking for those dynamically adjustable, the software geekery would be agile solutions to those dynamic problems, because they're going to change tomorrow and again and again. The even more macro answer to your question, I think, is where energy, food, and water come together. I think is going to be a huge amount of innovation in that space. When a river runs dry because climate means there's no rain, and that means you can't cool, your nuclear power station's got to shut off, and farmers are trying to suck the water out to irrigate fields because it's dry. Problem on problem on problem. So the way to innovate around that kind of energy, water, food nexus, I don't know what those investments are, but they're going to be awesome.
Mary?
Obviously, I'm biased because we do climate technology only, nothing else, because that's what matters to us. And looking at the climate of today's world, there's going to be apparently a crisis in the US, downturn happening next year. We're going to tighten our seatbelts. there's never been a better time to invest in early stage because late stage is kind of taking a hit now. We see that. When it comes to climate technology, that's something which I understand. There are maybe 2-3 areas which I see tremendous potential. Things like rust, steel rusting or iron rusting is a $2 trillion industry, And so my point here is sustainable materials because we need to produce things. The problem is that we do it using fossil fuels, and it's not very helpful to anybody on this planet. So these materials are going to have to be sustainable more and more. There's another thing which I see has a tremendous potential. This is battery storage. Yeah. One company we invested in went public last year at $2 billion valuation. This energy needs to be produced and then stored somewhere. And it's a massive space, and if we solve this occasion, it's going to be a big step for the mankind. So these 2 areas are very, very important. Maybe one more is software should not be underestimated because
Peter would agree with you on that.
Even in climate, there's plenty of goodwill we can get as a mankind. There's a company which we work with. They analyze satellite images, and they can predict forest fires for up to 10 days with a precision of 10 by 10 meters. And if you look at all the forests which the planet lost in the last 20 years, a third of them is due to fires. So,
as an Australian, I can experience that.
And software like that has an instant scale of the whole planet, can help you tomorrow. So these are the kind of 3 main areas, in my opinion.
And Will?
So if I could, I'll answer slightly differently, which would be, I guess if I wasn't running Octopus Hydrogen, what business would I have liked to start? So my biggest annoyance every day is that I can't think of a good business that would be able to solve the problem of, right now, in the UK, we worry about how are we going to decarbonise the last 20% of our power generation. And so we go through this exercise all the time, through policymakers and National Grid and generators going, it's every 5 years for 3 weeks, the wind won't shine in the winter, and we're going to really struggle to get enough electricity to our homes. Therefore, we need to invest billions of pounds in solution X, Y, and Z. And I'm like, okay, yeah, it's a really big deal, that problem. But you've got other countries building more coal every day than we decommissioned in the last few years. So why don't we use those really expensive bits of problem solving that we could do in the West and deploy that capital into problems that other countries could solve tomorrow with technology that already exists? So I can't think of a good way of doing that. There's some sort of value accounting, geopolitical kind of company level thing that could be done that would solve that problem. And that's the business if I wasn't running hydrogen, wish I would have started, but I haven't got a good solution to it. So if anyone has an idea in that space, I'll invest in it.
Well, that concludes the panel. I'd like to thank everyone for your participation and for your answers. Much appreciated.
I'm incredibly excited to be here this afternoon and introduce a female panel for this afternoon's investment trends discussion. We have got a phenomenal group of ladies here to discuss not only the trends in the investment market, but also things that specifically impact minority founders or investors, which is actually very key going into 2023. I'd like to take some time just to introduce each of the panel members. They're going to just introduce and tell you their names, a little bit about what they do, and then we'll start sort of racing through some questions with them. Saloni, do you want to start?
Sure. Hi, everyone. Nice to be here today. My name is Saloni, and I am one of the co-founders and partners at Pink Salt Ventures, which is the UK's first female founder-focused fund.
Hi everyone, I'm Eva and I'm part of True Altitude. We are an investment firm and advisory focusing mostly on the early stages, helping founders get investment ready, become more investable, and make sure that they can scale better, reach the path to profitability faster as well. Really excited to be speaking here today.
Hi everyone, thanks for having me here today. My name is Pauline Lee. I'm the co-founder and managing partner of Madonna Capital. So we're growth partners to seed to Series B female entrepreneurs. And what we do is we help our entrepreneurs get investor ready. Then we manage the fundraising process and get them funded, as well as bespoke consulting based on my background being a CFO. And we help them grow and get funded. Thanks for having me.
Hi, my name is Kesia. I'm a co-founder of 01 Founders. We exist because the world needs more software engineers, but that are not just white, male, and privileged. We need coders that are women, who are people of color, and who come from a variety of socioeconomic backgrounds. And so we call ourselves an alternative software engineering school, where we take someone from 0 to full stack in 2 years. We're not a quick fix coding bootcamp. Everything about our business is designed to promote upward social mobility. We do this by making it entirely free for the student. We don't require any sort of academic background or previous coding experience to apply, and we guarantee a job for every single one of our graduates. We also approach the training in an entirely different way. We don't have any teachers. It's an in-person program, but all based on peer-to-peer learning and project-based learning.
Hello, everyone. My name is Dominika Soriano. I'm Venture Operations and Ecosystem Lead in Cambridge Future Tech. In Cambridge Future Tech, we are deep tech venture builders. We work with innovative technologies and scientific discoveries. We are working with early stage companies, often before incorporation, when we are providing support as a commercial engine all the way throughout their life cycle. My main responsibilities are in operations, legals, and finance activities, and I also manage relationships with wider ecosystem we are in.
Thank you. And just to sum up, because I'm going to be chairing today's event, my name is Rosanna, and I'm the CEO of .coms. .coms was invented to help doctors and nurses and all medical staff communicate without having to resort to social messaging. I don't know if anybody's medical in the room, but at the minute it's a huge problem within our hospitals and around NHS that actually people are communicating using their personal phone through text message or even Snapchat at times to get videos across. So we've come up with a solution. We can allow people and doctors to send images very quickly, all in real time. We then catalogue that using NHS numbers or unique identifiers and allow that data to be used going forward in that patient's record and obviously for research going forwards as well. So we have a complete range, a totally diverse team of people in front of you. And what I want to do, if I can, Pauline, I'd like to come to you first.
Sure.
So we just want to talk about some of the trends. That's what this panel is entitled today. In 2019 and 21, we have seen a huge surge in AI, deep tech, a lot of these key trends sort of really surging forward. But in 2022, we've seen a real slowdown. How do you think we're going to be seeing, or what are we going to be seeing in 2023?
Yeah, sure. So I think in terms of the industries that you've mentioned, Web3, AI, deep tech, and fintech. Fintech is, always going to be around, with London being kind of the hub of that in Europe. And I think it's maturing. So I think that the pace of the growth is going to slow down, but there's always going to be a need for fintech. In terms of the, real investment trends at the moment, and I see decks and businesses where buzzwords such as AI and Web3 and crypto and blockchain are being thrown in just to get meetings with investors. And I think that in terms of Web3, it's still growing, and crypto especially. We can't talk about the investment landscape without mentioning crypto, especially with what happened with FTX last week. It's a very high-profile sector, but very little understood. So I think that it's probably going to bounce back towards the end of 2023, just because investors are going to be more cautious when it comes to the bad rep that crypto is giving itself at the moment. In terms of, so I think all those industries, I think it's still growing. We're going to see more of it. We're going to see different iterations. And I think there's definitely value in, its investment. There's a place for it for sure in the venture ecosystem. And I think that anything that is to do with impact and purpose-driven investing is going to become very important. So that is quite a broad range. So what I'm talking about are businesses that are good for people, planet, and profit. And I think a lot of investors are realizing that you don't need to they're not mutually exclusive. You can make profit and still make a difference in people's lives, as well as, be better for the environment. So you see a lot of, ESG being pushed down from LPs to the GPs, and the mandating, percentage of portfolios or, some kind of quota when it comes to ESG. So I'm seeing climate tech, especially with the, energy crisis, anything that will improve its efficiency and productivity, looking at energy, climate tech, and health tech. So life sciences, med tech and health tech. It's still an industry that is ripe for disruption, not for destruction, sorry. And I think that anywhere where you have a huge problem, there's a huge opportunity. So I think I think those are the industries that will...
That's great to hear. So things that are going to make a difference, essentially.
I hope so.
Yeah.
I mean, we can all make money and have an impact.
Great. And what sort of barriers do you see facing those founders over the next few years?
Yeah, so I think that 2022 and 2023, in terms of the number of deals in venture has really decreased in Q3 2022. We saw a huge kind of surge in 2021 because of all the dry powder that was built up over the pandemic. So when you look at, I guess, the levels of investments being made in 2022, it's still kind of healthy. I know there's all this doom and gloom. I think 2023, midway through 2023, is when you'll see a real crunch. I have seen and heard of a few, prominent funds who weren't able to fulfill the obligations when it comes to funding their portfolio companies because of a liquidity crunch. So, I guess really got to watch out for that, and, having someone on the inside and understanding the fund life cycle of particular funds as a founder is very helpful. This is why Madonna Capital exists. I'm going to plug myself here. And so I think that, founders need to think about capital efficiency. They need to think about what problem they're solving for. Is it big enough? And do enough people care about it? And does it get the investor excited? So yeah, I hope that answered the question.
Yeah, that does. Actually, I might just open it out to the panel as well, because if we're talking about barriers to founders in general, are there any that you think particularly would affect females or minority founders specifically? Does anybody just want to jump in there and just talk about things that would be really important to represent themselves as a founder?
I can start. I don't want to keep talking, but I guess when it comes to female founders, the statistic shows that over the past decade, only 2% of funding goes to all female founder teams, despite a growing number of female founders. And we've seen a huge growth in 2021 as well as 2022. So, there's something wrong there. And what are those barriers? I think there's two types. One is intrinsic and another is extrinsic. When you talk about intrinsic, you're really looking at the belief of a female founder in themselves. So there's a thing called the confidence gap, where females are less likely to start a business, until they've got all the information in front of them, and just because of our risk-averse nature. But that also makes for better leaders because of, the risk-off, as well as the attention to detail. And there's a study that shows that, a lot of 60% of female-founded scale-ups survive beyond the 10 years, which is incredible when you think about, how startups and scale-ups fail within the first 2 years. So that just really shows that female-led businesses are sustainable. There's also a study to show that female-founded businesses outperform male-founded businesses. So the fact that, the statistics kind of speak for itself.
Yeah, absolutely.
I'm gonna contend that point though. Sorry.
Do it.
If I'm allowed.
Yeah, of course.
The ROI stats on female versus male-founded companies, I mean, yes, it's compelling. Female founders return more on the dollar than male founders, but it's based on a really tiny data set, right? It's based on the few female founders that do raise that capital and go on to build big businesses. But the fact of the matter is that because of the barriers that you referenced, and we can go and we can unpack that a little bit further, only the cream of the cream is getting that capital and therefore returning anything to investors. It's the same as what you see in the Supreme Court. You know, the newest Supreme Court judge has like the combined CV of everybody else, and she's a woman. You see it in big organizations where, you know, the C-suite of a big company has one woman and she's got the combined qualifications of the rest of the male C-suite. Sorry, guys. It's just true, right? And we see this across big organizations. And so this is the same problem. It's all well and good to say like women are better founders than men, but the fact is that so few of them even get funded. So the ones that are getting funded are the really, really amazing ones, the breakout ones. And you know, our fund thesis is purely that women are treated as if they can't build as big of a business as men, but the reality is that they can build as well as men, and they can create the same type of return profile that male founders do. But I, you know, when we hear, you know, we see this statistic a lot, and a lot of our LPs ask us about this, and we're like, no, it's not that that they're better founders. It's just that they haven't been given, not enough of them have been given a shot on goal.
Yeah.
But with regard to the barriers, right, to just add to Pauline's point, you know, there is that sort of confidence gap. There's the role model problem. You can go on and on about STEM education and younger women, all of these things, but actually the other pretty interesting statistic or research. So one of our advisors at the fund is a professor called Donna Kahns, and she's a global thought leader on why women are underfunded, from a GP perspective, from a founder perspective, all over the shop. And her most recent research that she did with HBS was actually that showed across, you know, several thousand venture capital funds that women get asked a lot more of the preventive questions. So talking much more about risk and what can go wrong in the business, and, you know, what are they going to do to defend themselves against competition, whereas male founders tend to get much more of the growth, the opportunity, the acquisition questions. And that in itself, you know, if you're in the room with a founder, you're the investor, and you're only asking them about what can go wrong and painting them into a corner, if you will, you know, do you really see that coming out with a term sheet? Like, I don't, right? It's just a very negative conversation. Whereas if you're talking about the growth, the opportunity, the prospects, that's a lot more compelling of an investment case to then come out with that. And that's all unconscious bias. It's not anybody trying to, you know, be sexist or misogynistic. It's just how we are conditioned because we grow up in the same world and we have the same sort of influences and simulation. But that's something that, you know, is very easy as in terms of from a fund structure to implement in terms of standardizing questions, how they are asked, like the actual script of how they're asked. And that can change. And, you know, we've seen this in some funds that have implemented this, and it actually changes the gender ratio in their portfolio over time quite significantly.
And you've written a very good article actually about it. It's about the case for backing female investors. So it's really important, so do carry on.
Can I first just quickly add an anecdote we were talking about earlier on the subject of human bias in female founders? When we were raising funds for 01 founders, I was 35 weeks pregnant. I was massive, and I remember being so grateful that I was doing this in the middle of the global pandemic because everything was on Zoom, and I used to just tilt the camera upwards so that you could only see my face because I didn't feel like I would be taken seriously as like a badass founder with like a massive tummy. You're very adorable as a very pregnant person, but I didn't think that I'd necessarily close the round.
But you did. You closed it.
Yeah, well, because I got to tilt the camera. I just don't think the world is ready for that sort of conversation yet. I think there's a lot of unconscious bias against.
Yeah, I agreed. So what advice would you give to female founders, for example, if they're going into sort of pitch? You know, how would you sort of get them to differentiate themselves, or how would you explain to them just to make sure that they really packed a punch in that pitch or that meeting?
I think I'm going to flip on its head and really ask, how is everyone going to make sure that there are more female founders who can pitch? So even getting the opportunity to pitch is difficult. So it's really, I don't think it's a female-only problem. It's really an ecosystem problem because, you know, we are 50% of the population, and in terms of, you know, the decision makers, 90% men. And so there's actually, from an investment perspective, you're missing out on a huge investment opportunity when it comes to businesses that are solving problems that, you know, involve women. And so, yeah, I think it's really about, you know, one of the barriers is, you know, in terms of venture and private equity, it's really still a close and trusted network. So I've seen, you know, deals being discussed and done over, you know, drinks at the pub with the boys or over a football game. So it's really about how do we open that up to be more inclusive? How do we open up the network to be more inclusive? And then, you know, have more women pitch, which is then the next stage. But at least, you know, how do you get more women in front of, you know, an IC?
Yeah. I also think, you know, to your question, you know, a lot of the time we take into account cultural nuance. So, I mean, for the investors in the room, when you have a German founder, I'm going to use stereotypes, right? If you have a German founder in the room pitching you about their business, you're going to take into account that they're German, they're pretty tight with their numbers, and they're not going to pitch you that they can build $1 billion business in 3 months, say they're pre-seed. And they're just not going to do that. Whereas if you have a founder from Silicon Valley, they might well do that. And you, in your head, you're taking into account those cultural nuances, those differences in how people with certain cultures pitch you. But the same should be applied, it's not necessarily applied to female founders. Now we know anybody who's ever tried to hire anybody has been aware of the fact that when you put out a job description, if you don't have the salary range and if you don't say that you only need to fulfill 3 out of the 10 qualifications, you're not going to get many female candidates, or the ones that you get, they're going to be super overqualified, right? It's like a known difference between the genders. And while it doesn't apply to every single person, it certainly applies to the majority. And so I think, you know, when we're in that room where we are in a position of writing a check, just taking into account that women pitch a little bit differently, taking into account that they may give you the most conservative view of what they can build, because most likely and more likely than not, they're telling you exactly what they know they can build and what they can achieve with their forecast, not what they could build potentially. They're never going to give you the base case or the best case. They're going to give you the worst case scenario. And if that scenario looks decent, then that's probably going to be a really, really good company. So I think, you know, I think the onus lies on the investors to know and take into account this cultural nuance the same way we do with a Japanese founder versus a Silicon Valley founder versus a UK founder versus whatever. You know, just taking into account that nuance, that difference, that would
So it's about getting more people through the door and really celebrating those differences and those
abilities.
But it's
and just knowing, like, you know, it's, you know, a female founder is probably going to pitch me differently than a male founder, the same way a Silicon Valley founder is going to sell me, you know, WeWork.
So how would you, at the due diligence stage, how would you ask questions or unique questions to try and draw this out of founders?
Draw what out?
So draw this information out or try and understand, you know, how they're going to operate this business to get those USPs.
So I mean, in terms of like our standard questions that we ask, it's pretty much the same as anybody else is going to ask, right? Like, and we don't have the problem of trying to balance out the ratio in our portfolio because we only invest in female-led companies. But you know, the kind of weird questions that we ask as a firm, because we do have like our standard list with the market size, the competition, blah, blah, blah. But the weird stuff we ask is, I always ask founders why they want to give away a part of their business. Because oftentimes I'm speaking to first-time founders that aren't from this ecosystem and they don't really, some of them don't understand the business model of venture capital. So I always ask them in an effort to sort of educate them around what I'm looking for. And then the other kind of weird question I ask, there's 2 more. One of them is why they want to be an entrepreneur. Why is it that they built this business in the first place? And I sort of nuance that or preface that with, it's okay if you say that you want to be an entrepreneur to be on the front cover of TechCrunch. That's a totally valid reason. You know, what I'm looking for in that question is really, how big do you want to make this, and what is the reason that you built this business, and is it going to keep driving you when shit is hitting the fan? Excuse my language. And then the third question I ask is always around exit strategy, which is weird for a pre-seed or seed investor, but I always ask about, you know, where they see themselves getting to, because we don't tend to invest in founders that aren't looking, or at least don't have the vision of IPOing or selling to a very, very large company. So we wouldn't really invest in anything that's sort of capped in terms of returns, in terms of return profile. There's plenty of amazing businesses that could sell and create life-changing amounts of capital for the founders. You know, selling, you know, a CPG business to Unilever or whatever, but that's not the return profile that we're looking for as a fund, even though we are a small fund.
Fantastic, thank you. Eva, I'm going to come to you if I may.
Sure.
How do you think capital raising has changed since 2020 and 21?
Yeah, so I think what we're looking at the moment is a couple of different dynamics. And first and foremost, there is record levels of dry powder waiting to be invested. I think we're looking at 290 billion, which is twice the amount that we were looking at pre-COVID. And whilst it is a possibility, it also signifies pressure, because the LPs will be expecting the funds to invest that capital in a timely manner. And that also means that the competition to find the next unicorns is tougher than ever. What it does in turn is that the focus is actually shifting to the early stages. So the early stages are holding up better than the late stages for the most part. It is in the growth stages where we've seen down rounds, we've seen the layoffs, we've seen the VC term sheets tightening up, and the VC model is turning to the early stages where they can still hope for the even 100x return. And by early stages, I mean like pre-seed and seed. And I think in terms of the sectors that are coming up to the forefront of discussions really, so I like looking at what's happening in the market nowadays because it's super interesting, because what we're looking at is a similar dynamics as we had about a decade ago. So when iPhone came out and we shifted to the mobile era, we've had Instagram, Snapchat, Uber, and Lyft all come into play. The digital advertising exploded. Then came the cloud, and basically SaaS business models were on the rise, the SaaSification of everything. That's when data became the most prized resource for a business as well. And I think nowadays, you know, back then, a decade earlier, we were also after a crisis, after a financial crisis. Now we are after a somewhat erratic COVID recovery. So it's kind of like a similar situation where right now we're looking at an intersection of different trends changing. So we're going from Web 2.0 to Web 3.0. We're looking at a next generation of social media, so where video is more important than text and image. And it's really starting to be this big shift where I think the sectors that we're looking at is AI and VR, AR as one of the most important ones. So I used to work for IBM when Ginny Rometty was a CEO, and she was saying that we moved from the computing era where computers could count, we moved to the algorithmic era where they could think in a code. Now I think we're moving on to the creative era where the AI can create. We've had this artwork win the AI art competition and so on. So I think what's going to happen basically in this decade, I think it's only in about 10 years' time that we're going to look back at this time, and we're going to find that this was the time where like the new Uber, WhatsApps, Airbnbs, and Slacks were created, the biggest unicorns. But I think that's something that we will only see in hindsight. So it's basically all, you know, it's all bets on those investors who can spot it in a times of crisis, because this is where the unicorns are born.
With data still being just as important then, so clearly.
I think so, yeah. I think like some of the best businesses I've seen nowadays are exactly those that can monetize on data. Yeah. And you know, you're doing one thing, but then you're building this huge database that becomes your entire new revenue stream. And you know, part of what we do with our clients is to help them scale in a way that can, you know, utilize all of those points. And yeah, I think that's, you know, it will be super interesting to see what's going to happen.
Exciting times, you heard it here first.
Definitely.
Keisha, I'd love to come to you next. As the co-founder of 0 to 1 Founders, you've done something unique and exciting, and you're trying to change the market for software. But have any of your founders become, also cohorts, become founders in their own right that you've trained?
Okay, so our London campus is 1.5 years into the program, and it's a 2-year program, so we don't yet have outcomes to speak of. But our tech partner, who we're doing this with, has got 17 campuses globally, and they see about 10% of their cohort go on to become founders.
So that's pretty impressive. It's quite good stats. Are you happy with that? That must be quite exciting.
We are happy with that stuff. We've got our famous example of an alum is the founder of Docker, who's gone on, which is recently valued in excess of $2 billion. Wow. It's an alum from this program, so we're quite proud of that one.
And what would you say the single most important sort of quality or skill for a founder would be?
Okay, I'm going to cheat. I'm not going to give you one.
Go on.
More than one. Listen, as a co-founder of a coding school, of course I think that technical skills are important, but there are some critical soft skills that we think are necessary for operating in a digital era. And they can be as simple as the ability to work with people that are around you, and the ability to work with people that are different to you, and how to progress using minimal resources, how to become autonomous in front of a not seen before challenge, and most importantly, how to develop a mindset for adaptability. I would say that's probably the most important one for a founder.
And Casey, do you think that's going to be more important going forward into the current economy and the climate, which, you know, nobody knows what's going to happen really next year, but do you think it's going to be more difficult for founders or for investors to see those founders come through and see their talent, or do you think it's going to be just the same, really, just as difficult to find talent as it always has been? How do you think it will change?
I think, listen, well-trained, diverse tech talent is difficult to find in any market. No matter the market, we have a shortage. In terms of talent generally, especially in a downturn market, we see a shortage of jobs. This is because companies are scaling back. We saw the announcement by Meta. Other companies are failing. So we find ourselves with a talent surplus, actually. This is because a lot of brilliant operators are being released back into the market. So it actually makes it a very exciting time to found a business now, because you have an opportunity to build strong operating teams that you might otherwise not have.
Great, I love it. Does anybody else have anything else to add on that?
On when you asked basically what's the most important skill for the founders, so I would say tenacity. So when Brian Chesky was fundraising for Airbnb, I think he got something like 7 no's from some of the most prominent Silicon Valley investors. Yeah. And I think the average conversion rate, so to say, basically how many investors you message versus how many you actually can get into a meeting with, is only 10%. And then I can't remember who it was, but I was listening to a podcast this morning where a founder was saying how after every single meeting he would edit his pitch to, you know, include some of the feedback from the previous investor, and the first check that he got was on, like, I think 106 iteration of the deck, because he was numbering it all. So it is really all about, I don't know, I always say that I think many of the successful founders, they are where they are simply because they didn't give up. Yeah, and that's what tenacity is the answer here.
That's amazing.
I'm going to counter that a little bit, and not saying that, you know, definitely agree, tenacity and the ability to pivot is very, very important, just because the market is so dynamic. But I will say that it's okay to give up as well as a founder. You just got to recognize when it's the right time, because, you know, just because you give up on this particular business, you know, I mean, Rome wasn't built in a day, and you're going to, you know, learn from each of these meetings and each of these experiences. And I think that mental health is very important. It's something that, you know, it's coming to a service, but, you know, it is very stressful to be a founder. And, you know, you've got to look at your personal goals and see whether starting a business, getting funding and doing that right now is the right thing to do for you at this particular point in time. And it's okay to say, you know what, I'm going to call it a day for now, take my contacts, my learnings, and then start again at a later point in time when the when the market is kind of give me a tailwind rather than being against my business right now. So I agree, you need to stick with it, and you got to recognize when to pause or when to stop and start again.
Great. Dominica, I'm going to come to you. So Dominica's at Cambridge Future Tech, and you work with founders and also IP. So it makes your due diligence slightly more tricky. Can you just talk to us about that and what you really look for?
So mostly we are looking for good founders, right, that are working with good technology that is research backed up. And I can just follow up on a previous question actually. We are looking for coachability, definitely, like Asia was saying, because our founders are very technology driven. There are definitely soft skills that they need to develop, like being able to communicate a vision. I was actually talking to one founder recently, and he's not out of our portfolio venture, but he was very frustrated. He obviously was a very smart guy, engineer, but he was so frustrated because he said he cannot get funded because nobody understands him. Like none of the investors understand what he is trying to achieve. And here's where I was telling him, well, this is a skill you need to learn. Talk about your vision, talk about your story in the long run as well. Or bring in someone to the team who can communicate, who has commercial experience and communicate this vision. So definitely coachability, communication. We, at least from our company, we don't want to hear only about the good stuff and the exciting stuff. We also want to hear about the problems, because as venture builders, we are here to support and solve those problems. And I do understand that it's uncomfortable sometimes for the founders to talk about the problems, but it's absolutely okay. Nobody expects, especially at the very early stage and in deep tech, to have all the answers. And the last one, I suppose, would be the resilience. Again, with the deep tech industry, the gestation period is quite 7 to 10 years. So you need to be able to not just celebrate the opportunities, but also roll with the punches. So I would say those are.
Okay. And what do you look for in terms of commercial viability for businesses? How would you judge that?
So for us, two biggest things is size of the market. So in deep tech, you need a larger amount of capital and reoccurring investment. This is actually something that founders are not often too good at, to assessing a market. And then a second one would be customer feedback. So getting customer feedback as soon as possible. It's okay to reach out even before the product or technology is finalized to get that customer outreach. For us, especially when we hear feedback that, yes, when can we buy it, we know that we are into something good.
Great. And how would you value ecosystems as part of that as very important? Can you just talk us through some of the things that and sort of why you would place such importance on the ecosystem the business sits within?
Yeah, sure. So we are in Cambridge, so I believe our ecosystem is very strong. And again, I'll draw back to deep tech industry and the long gestation period. It is important for us to have that support, not just within a company, but outside from our advisors. We do have a number of amazing advisors, and this helps with diversity and skills and experience, and therefore mitigates the risk of deep tech, which even investors are looking for, and also ultimately brings higher revenue as well and growth. My favorite example is gaming industry in Finland, because I love gaming a lot. They have very open knowledge practice, so even a founder who is starting a business can go and talk to a CEO who is already successful, because they all understand that the collaboration does eventually bring higher growth revenue. So I would say this is very important. And just in a safe environment, of course, the holders feel that they can do higher potential risk and predict the future better.
I think it's safe to say all of you are very passionate about investing in females and also successful and promising entrepreneurs and good ideas, essentially. But what would you say is the most important thing for, when you're looking at a founder, how do you help them through the ecosystem when you see them? Would it be to help them in a very specific way, or would it be to sort of educate them? What can be done to really help them through the ecosystem? I'm going to come to you first, because I know this feeds off the back of your previous question.
So when we talk about founder in general, in founders, so I guess the first is exposure to the ecosystem, introductions, definitely, and then listen to their needs. So our programs are very tailored. So we don't really have, this is what we do. We always talk first to the founder and assess the needs, and then based on that, create a program. So.
Great. Does anybody else want to jump in and just talk about founders in the ecosystem or anything?
So I think what's important, and Dominika mentioned that coachability is a huge element. And I was recently speaking with a family office, and then basically they said, what we want founders to tell us is to be able to recognize what do they struggle with and where are their gaps, so that we actually know where to help them. And I think this is really important as we're shifting to a lot of the VCs I spoke to in the last quarter. I think our team collectively spoke to over 300 of them. There's more and more emphasis on the support that the portfolio companies receive, not just monetary checks. And so I think what's super important is the self-awareness on the part of the founder that, hey, this is actually what I'm struggling with, and I'm raising the money and I'm building my networks in order to fill in this gap. And I think that sort of level of transparency and straightforwardness will be much more appreciated by the investor as well. Yeah, and it just speeds up the whole process, really.
Yeah, that's great. Anybody else to add anything?
Yeah, I think I agree. Exposure. We can talk about mentorship, and that's something I do. Is really to get the founder investor ready, especially when it comes to first-time founders. There's also an education piece. We were just discussing before coming on this panel that not every business is a venture-backed business, and not every business requires venture investment. So it's really about educating, what kind of, funding they might need. I mean, in terms of alternative financing, there's loads of options out there at the moment, so it's about the education piece. But at the end of the day, really, it's about money, because money is what drives a business. It's what helps a company and a business grow. So exposure, introduction to, the private network of investors, and then really just collaboration between founders and investors.
Yeah, I mean, the way I see it, right, in VC, if you're not, the sort of three areas that all founders want help with are access to great talent, access to commercial contacts, especially for B2B businesses, and access to follow-on funding, and other co-investors in the round. I think I see those as table stakes for venture capital funds. Like, cash is cheap at this point, so every VC should be supporting their portfolio with these things. But the way that we work with our founders, aside from those things, is so Samira, my co-founder, has much more experience in consumer and go-to-market strategies and brand. So depending on the portfolio company, she's definitely the one that plugs in there. My background is much more in double-sided marketplaces. I launched 13 cities for Uber, and then also the B2B stuff. So I've built large enterprise sales teams. And so I typically work with our companies on those aspects, depending on their business model again. And then the other thing we do is we also, when preparing our founders for their next raise, we do actually coach them on how to navigate those narratives and avoid making them a downside risk related conversation, which is a very counterintuitive way of running a conversation. So we sort of do those kinds of coaching sessions, and that's been really helpful for a couple of our founders that have then gone on to raise really competitive seed and Series A rounds. But really teaching them to navigate okay, I see that this investor is painting me into a corner, let me flip this conversation on its head. So that's the sort of other weird pink salt stuff that we do.
Well, it sounds great. I mean, for me personally, as a female founder, it's hugely encouraging to meet you, to see you up here for Wholesale Investor, to give you this voice and this platform, because it is encouraging as a female to come into a room and see other females sat at the front talking about their experiences and giving their viewpoint. And I think it's hugely important that all types of investors and founders are able to do that. So I'm incredibly grateful to you all. I've got one more question, which we're going to end on, and then I'm going to let you go because I did promise you we'd finish on time. So we've talked about the market, we've talked about the investment trends. You've sort of suggested things that we can do to help founders, but we might have some aspiring angel investors in the room, and it might be one of their first forays into the market. What piece of advice would you give to an angel investor to either encourage them to invest or just to be able to assess the market or even the company that they're looking at? Do you want to go first?
Sure.
You nodded, so that was it. You're on.
Sure. So I used to be an angel investor, and then I changed that from my side hustle into my main hustle. So I was angel investing in female founders. I would say there's two things that I would advise any aspiring angel investor to do. One is, does it make sense for your portfolio? Don't start angel investing when you have no allocation in the public markets and real estate and all of the other asset classes. Let's be practical here. And then the second is, why are you doing it? And your why is going to dictate how you map out your portfolio strategy as an angel investor and how you pick your angel investment thesis. If you're doing it as a way into the VC ecosystem, if you're doing it just to make money, the profile of companies that you're going to be investing in is going to be totally different. So I think, figuring out your why is the main thing. I started out kind of doing it very ad hoc, and I would not recommend my way of getting into angel investing to anybody. But yeah, I think really figuring out why is it that you're doing it.
Yeah, so I think my advice would be to make use of what's available out there, whether that would be syndicating with other angels or using some of the angel forums that co-invest together. I did a couple of investments as an angel investor myself, still waiting for them to IPO. But obviously not going to happen anytime now. But what I wish I knew sooner and what I would advise founders to do is to actually make use of some of the fantastic networks that are out there and the help that's available.
Yeah, you kind of stole my answer. But yeah, I would advise to join some syndicates and learn from seasoned angel investors. For me, really, it's about having the best information to make the decision on investments. And you can start small. You can maybe join seeders if you kind of just want to see what's out there and how other angels think about it. For me personally, I build relationships with the founders that I invest in, and I get to know them over time, and then I back the founder. That's really what angel investing is about. And then there's loads of resources out there besides syndicates. There are investment schools, so I know Female Invest is a resource that you can use. There is, I think, loads of angel schools out there as well. Just for you to learn, I guess the process, what to look for, and then make use of your network. When you talk about angel investments, there's a school of thought that really you need to invest in about 40 to 50 opportunities to actually make an outsized return, which is, because lots of early stage businesses fail. And so, yeah, it's really about who you know, and also the quality and the frequency of deal flow that you get. So get out there and network, talk to other investors, come talk to me. Yeah, I have deals for you.
I don't think I'm the most qualified to comment on this, but I do come from a family of venture capitalists, so I'll say I'll comment on what I see around me. It's certainly, as my panelists had said before, investing in your network, in the sense that you really want to surround yourself with a trusted group of advisors in terms when it comes to deal flow, because they're the ones that are on the ground, sometimes doing a lot of the homework for you. And so if you can tap into unconventional pools of talent, that's certainly where the most exciting founders come from.
That makes a lot of sense. Dominica, do you want to
So for me,
finish up?
the same. I would just say really what already they said, to make sure you talk to somebody who has experience, research the technology you want to invest in, and now it's actually a really good time to invest in seed and pre-seeds as well. So.
Great.
So first of all, thank you for staying here. And thank you for having me this afternoon to be your kind of final roundup. My name's Jenny Tooth, as you've gathered. I'm Executive Chair of UK Business Angels Association. I was Chief Executive until this year. So just to kind of, really kind of help set the scene a little bit, I've been investing myself as an angel for many years, but most importantly, I set up UK BAA in 2012 to really try to mobilise and bring together many more of the investors across the UK to back great entrepreneurs. You'll probably remember after the financial crisis when the banks had really stopped investing, in entrepreneurs. And all the VCs had sat on their hands. So David Cameron pulled us all into the room and said, we need more angels. We just need more people to back great entrepreneurs. So I had the great privilege to set up UKBAA at that time. And we've been growing it, ever since. So great to be here this afternoon. I just wanted a quick show of hands, and not to kind of expose anyone, but how many of you are angel investors in the room today? Great, good to see some. That's really good. And how many of you are entrepreneurs who may be looking for angel investing? Wow, okay. Well, we'll try and cover all ends today, but so I'm going to talk quite a lot about the market and kind of situating things as well. But just for those of you who don't know UKBA, we're very much an ecosystem organisation. So I work with about 18,000 angel investors across the UK, mainly in angel groups. We talked earlier this afternoon actually about being part of a syndicate, and I'll say more about that. But angel groups, about 86 of those across the UK, also lots of individuals. I work with venture capitalists, crowdfunders, accelerators, and lots of kind of advisors and policymakers. So we're a real ecosystem. And our role is very much to build and connect great entrepreneurs with great investors, to connect investors with each other, obviously, and build great deals. Also to kind of promote angel investing, get more people investing, and educate those players. I'll say a little bit more about that shortly. And really to promote this space to government and make sure they continue to give all the great tax breaks and support that angel investing needs. So, it's an important area for those of you who are less familiar with it. And I thought today we'd just cover quite a bit, just a little bit about, let's talk a little bit more about angel investing for those of you who are less familiar with it. Let's look at the kind of market around it, what are we focusing on, and really think a little bit about somewhere the challenges are at the moment. So we'll just work our way through that. But I thought...
We cannot hear you at the back, sorry.
You can't hear me at the back. Is there any way that anyone can turn that up, or do I need to stand at a mic? Or you can come and sit at the front. Can you hear me now? Maybe it's a kind of an acoustic thing, so I'll stop marching up and down so much. Apologies. I hate standing at lecterns, so, I'm lucky to have a mic. But I thought we'd start by just making sure everyone understood what a business angel is, because it's frequently misunderstood, because people often think it's to do with people putting money in funds, or do you get the money back, and all of those things. And I think it's really important to bear in mind how important business angel investing is, because it's about individuals using their own money. We use our own financial spare capacity, not obviously betting money on, on the school fees, your house, your pension. This is spare money, but money that we want to put into entrepreneurs. And we choose those entrepreneurs, and we invest not only money, but our time, our business experience, our skills. And that's why it's so important to entrepreneurs. And it's very much, worth bearing in mind that, we take shares, but we have no idea, obviously, whether we'll ever get that money back. So it's a big risk. It can be 10 to 12 years until you get your money back, or you see a return anyway. And of course, quite a lot of those are likely to fail. So again, big part of that risk. We nearly always co-invest as syndicates nowadays. And if you're looking for angel investing, it's always good to look for a syndicate than it is looking for trying to pull together lots and lots of individuals. So, that is very much the name of the game. And, if you just think about it, it's that first piece of money when you've proved the concept. You've built the business enough to have something to demonstrate. We're not on ideas. We very rarely invest off a sketch or a piece of paper. This isn't something that you've just thought of. This is something that's already got something to demonstrate. You've probably already even tested out quite a bit with some customers. You can be totally non-revenue generating. We tend to back that kind of really early stage. But it is when you're ready to grow. This is not, you're not just still trying to put it together, okay? You've got to show whether it's a service, a product, whatever it is, there's something to demonstrate. We can understand its potential. So that's very much, where we come in. And often you might well have bootstrapped. And, we often look, say, what have you done already? Where have you found some money? You might have had a grant. You might have been lucky and gone to bank and mum and dad, maybe probably maxed out credit cards. And we come in at that moment when we think you're ready for that piece of money, that very first piece of money, which will tend to be around, as a syndicate, around 100K. It's not really much use putting just much less than that in if you're really trying to get somewhere. So if you're looking for a much smaller amount of money, probably not angel money at that point. You need to you could do a bit of crowdfunding, although that's not that easy. Look for grants, look for opportunities. But I think 100K is a baseline, below which you shouldn't really be looking. But beyond that, generally angels will start to peter out around 2 million, particularly around that first round. So, situating this space is very, very important when thinking about whether it's angel money you're looking for. And what we tend to do as angels, the angel community will put more and more rounds of funding in, if you've got the right angels, until you reach ready for Series A. And for those of you who are angels, you'll know only too well, it's quite likely the entrepreneur will come back for more money as they've gone into that next, growth phase. And I will say that in the current climate, I think we're all expecting that we're going to have to fund those businesses for even a few more rounds before VC comes along. So you have to be prepared as angels to work with the entrepreneurs and the entrepreneurs with angels through what is quite, an important growth phase before you can really start talking to those VCs. And then obviously then you're ready for that next piece of growth money and hopefully more of that. Interestingly, as angels, we can get out sometimes along the way, but more frequently, if it's a great deal, we'll want to stay in to the end. And we'll tend to be looking for around 10 times return. And that's worth bearing in mind when you're approaching the angels as well. So if we just look at the market in the UK, I think one of the big things we have to bear in mind is that it is heavily concentrated in London and the southeast, more than 60% of that capital. But if you look at the market overall, and it's very hard to understand the angel market because, as you can imagine, they're private individuals. How do we know what they're doing? We only have access to certain data, and I'll say a little bit more about a very, very useful stats from Bohast. So we tend to use the tax data from the Enterprise Investment Scheme, which I'll say a little bit more about. And we know that about every year, 2 billion of that private investment is going into entrepreneurs, about 4,000 entrepreneurs. And we've been doing that for 27 years through the EIS scheme. So this is very strong. That's a considerable amount of money when you compare, venture capital. It is a really serious amount of money that is being invested. And, quite a useful stat to know is 60% of scale-ups have had angel money at the start out. So that is what you need to be thinking about. And as angels, we're looking to scale. We're looking for businesses that can scale. And as a business, you're looking to be on that scaling journey. So I mentioned about syndicates because it's fundamental whether you're an investor or you're an entrepreneur. If you're an investor, I genuinely say don't do it on your own. It's really tough going. You actually have to think very hard how you're going to do that deal. Keep on putting those funding rounds in and keep building and supporting a business when you're on your own. And it's all down to you. So how many can you hold at once in your portfolio if it's all down to you? If you're an entrepreneur and you just pull together a range of kind of, well, I'll say a motley number of different investors, that's also very challenging because then who are you answering to? 20 different questions of how you're doing. When angels invest in a syndicate, they'll share the deal flow, they share the risks, they pool the ideas and the experience. It also means you can build the deal much more easily and attract other investors alongside. It also gives you credibility. Otherwise, you spend your whole time trying to respond on your own to a wall of entrepreneurs. And this way, it's organized for you because you'll tend to have created a structure around which you can, get deals and look at deals and evaluate deals. Genuinely, I think you shouldn't angel invest on your own because it's too lonely. It's a very social thing. And I always say invest in a syndicate. So invest in a syndicate and look for syndicates. They are the best way. And I'll say a little bit more, but at UKBA, we have a huge raft of syndicates and you can check those out on our directory. So if we look at the market right now, where are we? Well, I'm sure most of you know that during... Can you hear me if I stand over here? Can you still hear me if I stand over here? Yeah. Right, okay. I'm just checking because I'm tempted to move. So what I would say about the market is, we all sat on our hands in 2020, and I think the angels were particularly affected when the pandemic first started. And then 2021, somehow we just all woke up again and equity became so frothy last year. And you will remember both as entrepreneurs and investors, the number of deals that were being done, a lot of mega deals at that. And actually, when we look at that market, it was very, very impressive. We brought together 24 billion worth of equity, and quite a substantial amount of that was angel too. And it was a really, really busy time. Huge mega deals, lots of opportunity. Deals got bigger, which wasn't necessarily great for the angel end. And I think the big thing that's worth bearing in mind, that sub $500,000, 500K, that amount of deals at that level has been falling over some time. Now, that's not saying as an entrepreneur you should go and ask for more. It's worth bearing in mind that actually is pretty much a sweet spot as well. But it's a tough one because the deals are getting so much bigger. And we also know that second time around deals were getting much more frequent than first time around deals. So this is, again, very important to bear in mind. So when we entered 22, it was still wonderful. We had a first quarter. We had over £7 billion of equity was invested at the start of 2022. This first quarter was amazing. We were obviously heading for even better year. And even the second quarter, we could start to see wobble, but it wasn't so bad. We'd gone down a couple of billion. It was like 5.7 billion. But things were starting to change. And I'm sure any of you who were looking for money in around June, July, started to see it was getting a little bit more difficult. The investors were getting more picky, and those valuations were definitely coming down. But as we look back at what's happened, and we all know what's happened. I mean, we know about Ukraine. We know we've had so many changes of government and so many changes of policy. And it's a global issue for us all. And I'm afraid it does affect the investment market quite dramatically as soon as it happens. I mean, not only at the big end, but also at the angel end as well. So we've seen now, the latest quarter was down to 2.7 billion only in total equity investments in the last quarter. So this is a time for concern. And actually the angel scene, has gone down as well. And you'll see there that, only 113 individual angels, and those were these are prominent angels whose names you'll kind of see out there, and only 30 odd deals being done by angel syndicates and groups. So it is It is a concern. Now, this is not to put the damper on everything as an entrepreneur, but it does mean you need to think about this. If you are a first-time entrepreneur looking for money, I think it will be tougher. If you've already got investors, I have to say our instinct is always to focus on our portfolio, focus on the investments we've made, and make sure we've got those still growing and moving. So it is going to be important, and obviously in terms of valuations and pricing, flexibility will be the name of the game as an entrepreneur. And as investors, we're obviously going to all try and avoid down rounds, aren't we? So, we need to be thinking about that. Think about the structure of deals. Should you be doing many more, ASAs, which have a very advanced valuation? Well, maybe not, because what will it look like in 6 months' time when that comes into fruition? Convertible loan notes, similarly. We need to think about this. The one thing we won't have is the future fund for any of those who used that last time. No, the government's not going to come in and bail it out. I mean, that's not going to happen. So it is going to be about people holding their nerve, being very, very clear what you need as an entrepreneur, and I think being very flexible in your thinking about your valuation, and being really, really strong, I think, on your, on your whole kind of, scaling, make sure you've got that scaling business clearly set out. Your plan for scaling and growth is going to be very, very important. So, as I said, we've got this issue now. We've got, a 28% drop in seed. Seed isn't just angel, by the way. It is that, there are many smaller seed funds as well that are around this space, and EIS funds and SEIS funds. It's all around that. We've got, fewer first rounds. We've got this decline in angel. Crowdfunding is not bad, but then it never is, because overall it's kind of mopping up a lot of stuff. But crowdfunding isn't right for everyone, and you have to consider the implications of that. But for those of you who may be looking, perhaps that's one option for you. What have we been backing? Well, probably quite predictably. I think that won't change too much, but I think what will be important will be climate change and impact. And I'm sure I don't need to tell you that, but it is really the name of the game for where many investors are looking. It's like if you kind of imagine all of those techs, the one thing you will always need to think about is, am I addressing climate change? Am I addressing sustainability? Can I prove a very big social and global impact? And if you can't do that, I don't think you'll get any of the other techs away. So think of these as underlying principles, because they've become our principles as investors. And it's not just about ticking boxes for ESG. It's because we actually do believe that the businesses we back should be doing some good. It's actually genuinely the case. We're very keen on fintech for good. We're very keen on medtech because, who can't be wanting to back, health and well-being? And even though life sciences, for example, is still very challenging, we'll all want to have drug discovery, won't we? We all want to save the world. So you have to think in those terms. And then the tougher ends are where it's already tough. It was already tough for creative industries. It was already tough for hardware. It was already tough for engineering and manufacturing. And we're going to have to think very hard because those are very important to us all as well. And, and creative industries, they came to the fore in COVID, and I'm sure we all want very much, to have great music, great video games, great stuff going around us, just important. But you have to bear in mind, we will be looking harder, and we will be wanting it to tick those bigger boxes for us as well. So if you haven't thought of that, make sure your story's there. And I'm sure as investors, you like me, agree that this is really probably where we want to be. I think it's really important to say about the added value that angels bring. And this is where it differs from crowdfunding, and it often differs from other things you do, because angels do it because they don't just looking to make fast money, because it definitely isn't fast money. It takes a long time to, really come to fruition. But we do it because we want to help. We want to give you introductions, contacts, links, give you the benefit, strategic advice and help, sitting on your board. And it's at times like this when we actually are at our best. And I think if everyone, as we as angels and investors, thought about what did we do under COVID, it was what could we do to help? How do you pay the wage bill? What can we do? And I think it's important when you approach angel investors to think, what do you need from them? Not just their money, what else can they give you? And that also helps when thinking, who do you choose? Who should my investor be? What should they look like? What should the lead angel be? What can they bring to me? It's a two-way flow. And I think that's very important. As we as angels, we tend to invest in an entrepreneur we know we could help. We know we could help. We could probably find you some customers. We can help. We've got some great links there. We know that market, So that's very much a two-way flow. And you can see from this, which was kind of a little recent survey we did of our members, just how important that is for angels to spend time with the entrepreneurs, because we know it makes a difference. If you don't want to be involved with entrepreneurs, don't be an angel, put your money in a fund, and that's not a bad thing. But if you want to really see how you can help, because what you do makes a difference to the outcomes of the deal as well. So it's really important to have that sense. So when you approach an investor, think what else it is you need, and don't be afraid to ask for that. We as investors will say, how can we help? So with that in mind, I'm sure you're all aware of it, but one of the points about all this is while we're helping, our government has actually been pretty good to the angel market, because the one thing they've given us for the last 27 years has been a tax break. And it's unique to the UK. I mean, other countries have adopted versions of this, but we were the first to bring in the Enterprise Investment Scheme tax relief, and it's gone through successive governments up to now. We're obviously all hoping that if the Labour Party get in next time, and we've all been making a strong case, that will all continue. And we think we've just broken past the barrier because it was due to expire on the 2025, what was called the sunset clause. And we think we've kind of made a good case for that. But for those of you who aren't familiar with it, if you invest in a company that is not a consultant, not in mining or engineering, but is in something which is, economically productive, technologies and risk-taking, then you can be pretty sure you would benefit from that tax relief. As an entrepreneur, it's your gift. So if you're backing a business that's kind of getting ready for growth, you will get 30% tax relief. You will also get a rollover of capital gains tax if you keep investing, and also inheritance tax relief. That's a pretty good deal. And then in 2012, when the end of the financial crisis and they brought in the seed enterprise investment scheme, it was to think that very much younger businesses could access investment. And how do we induce investors to do so? Well, we give them an even bigger tax break. So instead of for every pound we invest, we get 50p back rather than 30p back. If you've sold a business or a property, you have half of your capital gains tax bill written off if you back the entrepreneur. I mean, what's not to like? It's an amazing deal. And as investors, we need to know about it, because when you're hesitating, that's the moment you think, well, I'll get quite a bit of this back, it's not much exposed. Even if the business fails, if you're a taxpayer in this country, you get loss relief as well. So the exposure is really low for anyone who's hesitating. If you're non-dom, it doesn't work, sorry, but it is very much, and obviously if you're not drawing a salary, but that's how it works. Definitely worth considering. As entrepreneurs, if you meet someone and they're hesitating, don't forget to tell them about that. And the other thing the government has done over time is brought in some very valuable co-investment funds. So we've had a 100 million angel co-fund, which has been in operation since 2012, and more recently a 250 million regional angels program, which is aimed at entrepreneurs in the regions and to encourage angel groups to have a pot of money that they can co-invest alongside government taking some of those shares as well. So a very, very valuable program if you're not aware of it. And if you're investing in certain other areas, like in Wales or the Northwest or Northern Ireland, they also have co-investment funds. So, you know, wonderful boosts alongside your own investing. And if you're an entrepreneur, be aware of those because, you know, it's a great opportunity if you're not in London to access that money. We asked investors how important it is, and for those of you who aren't aware of it, it's very important. You know, over 80% of angel investors would use the EIS. Why do we do it? It helps us back more businesses. It helps us put more money into small businesses. It helps us take more risks. If the government took that away, we know the angels would invest a lot less and many would potentially withdraw from the market. It's that important. Maybe we've become a bit addicted, but I think it's the most tremendous opportunity. So, you know, whether you're an entrepreneur or an investor, know about this scheme and make sure that you take advantage of it. Right, I'm about to say something that's even more serious, because here I am, a woman investor. I met a few more today. There were some wonderful ones on the panel today as well. They're just not enough of us. There's only 14% of women in the whole angel market. That's really bad. Really, really bad. And of course, that impacts on entrepreneurs. We didn't even know how bad it was until we commissioned some research this year from Beauhurst with the support of NatWest. And we came up with this, you know, incredible realization of just how bad it was. And here's the interesting facts about all this. We have 36,000 angel investors. I only know probably half of those across the UK, and only 5,000 of them are women. You know, that's bad, isn't it? That's bad. But what's even more interesting out of those stats is if you look at really what very small portfolios very many investors have, both men and women actually, but only 157 women have a portfolio of more than 10 businesses. So this is, you know, this is really serious. But actually, strangely enough, only just over 2,000 men investors have more than 10 businesses in their portfolio. And I have to say, you need a portfolio. You need to build at least 15 investments if you're going to really get some great returns. You may be lucky with less, but overall, you need to focus on building a portfolio over time, which is why smaller investments alongside a syndicate over time build a diverse portfolio. And what we don't have at the moment is enough women in that market who've had the experience and longevity of investing to start to build a portfolio. So it's very, very important to us all that we need more women, more experienced women in this space, building portfolios, more syndication, obviously. But also, just want to tell you that over the last 10 years, women have participated in over 2 billion deals. We've actually created 10,000 jobs, you know, huge amount of added value, you know, and really supported so many small businesses. So we know that if we can have more women in that market, just think how many more women founders would get backed, and also how many more entrepreneurs generally across the UK would get backed. So for those of you who are women in this room, and there aren't enough of you in the room today, I think there might have been earlier, do consider angel investing. If you know more women, make sure they know about it. It's incredibly important we have more. And why do I say that? It's because women have more than 25% of businesses, often even 50% or 100% of their portfolio will be women founders. So if we have more women, we'll get more women founders investing. And do you know, women at this moment, only 10% of angel investing is going to all-female teams, and only 22% going to mixed teams. The rest is all men. Not good. I'm sorry. I know you're great, but it's not good enough. Sorry. So I just want to kind of end by saying, you know, we've mentioned some support areas. It is important to consider it. If you are building a syndicate, think of the opportunity offered by the British Business Investments co-investment funds. If you're an entrepreneur in the regions, bear that in mind. It's very important also to know those of you who ever look for R&D grants, Innovate UK put great grants into small businesses. As an angel, that de-risks those businesses and actually forms very important undiluted co-investment when you're backing innovative businesses. So bear that in mind as well. They back all kinds of amazing sectors. We at UKBA do a lot of pitching, a lot of showcasing. Do keep in touch. It's very curated deal flow, generally in relation to all kinds of areas. So make sure you look on our website. If you're building a business, if you're building a deal as an investor, or as an entrepreneur, you've already got 20% of that investment already, you can go onto our deal share site, and that would be made known to other investors who want to come alongside and co-invest. It's not for anyone just looking for money. It's when you've already got some investment committed, or you're an investor who's already committed. So this is very important to note. Free. And of course, if you want to know more about angel investing, we have a huge amount of information, and we also have an online educational course. I'm saying that because we need more people to invest. Knowing about it, understanding it, and getting it right is absolutely fundamental to your success as an investor. And as entrepreneurs, you want savvy angels, don't you? So, that's all very good stuff to know. And you can find us there on our website. So I'll just ask if there's any questions before you have the drinks. Right, floor duel. I know it's at that time of afternoon. If there's anything else you want to know, also you can find me out there, or you can find us and look on the UKBA directory. Oh, sorry, we have a question.
Yes, is it like a platform with a searchable database? What is the best practice to talk to investors?
So we have a directory of all of the angel groups and syndicates, and all of the early stage VCs and seed and the online platforms are all listed there, and so you can kind of make those engagements. So that's a completely free service if you're looking for investors. Hi.
So you said sustainability is sort of one of your core. So how do you assess that in businesses that come looking for investors? Do you have a team?
No, I mean, just to be absolutely sure, we don't invest, and we're not there to do the due diligence. So you're very much there to approach investors with a business that you can show, has sustainable principles or is addressing climate change. What I'm really telling you is that if you want to add value to your business and can show that you are, and to be honest, it'll be almost a core requirement going soon anyway, that investors will want to see that you are ticking those boxes. And to be honest, no one should be building a business right now that isn't going to make an impact. Surely everything you do now is going to be about making an impact. If you can't make an impact on the market, the need, the challenge, the issue, you shouldn't be building a business, because you need to build a business that has an impact. And we as investors will look for things that, this is going to have a huge impact if I invest in it and help it grow. So, it's a core consideration whether you're an entrepreneur or an investor. I'm sure you'll agree. And I think we can't, any of us, ignore the importance of ensuring that any business has got some thought about climate change. And when I say sustainability, I don't mean just have you got a long-term growth plan. I mean, are you looking to address sustainable issues? Yeah. Yes, hi.
There was interesting data there on female angel. Do you have statistics or data around those who identify as disabled being invested, and more people of colour also investing?
Yes, what I would say is there's less data around disability. I think it is a kind of new and emerging area. There are investors that particularly address, I would say, neurological, many investors back, people with, autism and Asperger's and so on, because there's a very kind of fundamental traits or dyslexia, because it often is a core part of entrepreneurship, many players have. I think the wider disability issues have not been properly understood in terms of both access or propensity to invest. When it comes to black and ethnic minorities, I've probably got a few stats, but there's a lot more to be had. We've just gathered our first ethnicity data from angel and VCs around this, and we will be issuing a report. But I'll tell you one stat that's not surprising, that probably the largest percentage of investing is in white male. It probably doesn't need you much to know that, and also in white female. There's only about 11% of the angel community are from a black or ethnic minority at this stage. We know from venture capital there's probably, while it's only 1% going to women of venture capital, about 0.7% of black and ethnic minorities. We do know that. What I would say is, so far we don't have enough data, but there's enough to tell us, of course, that first of all, there's not enough black and ethnic minority founders coming through the pipeline, and there's not enough of those going forward for investment. But I would say, I think it follows quite similar principles also about the women, in that we do need more people from black and ethnic minorities to invest, as well as, to access investment, because we need that mix inside the investor base. But we have got some data coming out, and we will improve that. I think there's a very strong commitment to diversity among a very core part of the investment community. I think we just need to kind of get better at it. The one thing I will say, we've got at least four black and ethnic minority angel groups that are part of UKBA right now and growing. So again, if you go on the directory, you will see those. And, and I'm obviously delighted at any syndicates or angels that want to come forward, to help them engage. But I think we have a long way to go still on that one, but I think it's very important to us too. But if anyone who is an angel investor and wants to understand this better, we have got, last year we published the UKBAA Angel Investment in Diversity Guidelines. Feel free to access them and download them, and hopefully inspire you to think about it. Well, hi, one more question. Metics. Medtech, sorry. Well, in terms of interestingly, I would say there's one thing, we don't have that many verticals. So we've got green angels, by the way, it's green angels. We have got, one or two, we've got science angels, we've got, deep tech angels. But I would say overall, the angel community hasn't divided itself conveniently, I would say, into verticals. But I would say it was right up there in the top list of people who want to, in areas in which angels invest. So you can count medtech as a very strong interest, but being clear, we're talking about a lot of it will be diagnostics and therapeutics, and then life sciences is a little bit more specialized, drug discovery. But medtech came in very strongly during the pandemic, and has stayed. So, you can be sure that if you have a good medtech business, you'll be very likely to attract that investment if you're looking for it. But again, show the growth, show the scalability, and show its differentiation, against other products, services, and technologies, because that would always be what we look for.